Welcome back, traders and chart enthusiasts. You're tuned in to part 2 of the audiobook series on Encyclopedia of Chart Patterns by Thomas Bulkowski, one of the most trusted names in technical analysis. In this installment, we'll be diving into chapters 11 through 20, where we continue uncovering the behavior, performance, and nuances of some of the most powerful chart patterns used in the markets today. Whether you're a seasoned trader or just starting your journey in technical analysis, this audiobook will give you the data-backed insights you need to spot patterns with confidence. If you missed part 1, which covered the foundational chapters and some of the most common patterns, be sure to check that out first. The link is in the description below. So grab your charts, fire up your trading platforms, and let's jump right into chapters 11 through 20 of Encyclopedia of Chart Patterns by Thomas Bulkowski.
Chapter 11. Broadening Tops. Results Snapshot. Appearance, price trends upward leading to the chart patterns. The pattern has a megaphone appearance with higher highs and lower lows that widen over time. Broadening tops, not surprisingly, look a lot like broadening bottoms. What separates a top from a bottom is the price trend leading to the chart pattern. For tops, the inbound price trend is upward. For broadening bottoms, it is downward. This is an arbitrary distinction I made just to see if the two chart patterns act differently. In answer to the question you have probably posed right now, yes, the two formations have slightly different performance, but both are yucky. A brief review of the results snapshot shows the performance rank is mid-range. Rank is based on how far price moves after the breakout compared to other chart pattern types. The break-even failure rate for downward breakouts in bear markets is terrific, just 9%, but that ranks the pattern at 11 out of 19, not shown. As small as the failure rate seems compared to the others shown in the table, it's still a mid-list performer. Average rise varies from 25% in bear markets, where the general market is trying to drown price, and 42% in bull markets, where the market trend tugs on the stock like a helium balloon. The average decline is 13% in bull markets, which compares to a 22% drop in bear markets. This time, bear markets are pulling price downward, hence the larger average drop than in bull markets. Broadening patterns come in a variety of styles and names. There are the broadening tops and bottoms, right angle descending and descending, expanding triangle, orthodox broadening top, and 5-point reversal. The last three, expanding triangle, orthodox broadening top, and 5-point reversal, are synonyms for the broadening top, with the last two being based on 5 turning points. For a tour of the chart pattern, look at figure 11.1. The stock began an uphill run in December 1994 and continued climbing to reach a high in mid-September at 53.75. Holders of the stock, enjoying the long run, decided to sell their shares and retire in Florida. The stock headed lower. On 25 September 1995, volume spiked upward and halted the decline. Investors, seeing a 40% retrace of their gains from the June peak, apparently thought the decline overdone and purchased the stock, sending price back up. Price peaked at a higher level, 54.50, on 19 October. Astute traders who suspected a double top was forming promptly sold their holdings to maximize their gains, sending price tumbling. Price confirmed the double top when it fell below the confirmation price, below the lowest low between the two peaks, at 48.75. Volume picked up, and the struggle between supply and demand reasserted itself. The decline stalled as traders willing to buy the stock overwhelmed reluctant sellers. Stock turned around and headed higher. By this time, chart followers could draw the two trend lines, one across the twin peaks and another below the two valleys, giving birth to the broadening top pattern. Traders jumped on the bandwagon at this point and purchased the stock. They wanted to play the anticipated rise as the formation broadened out. The stock cooperated and moved higher, reaching the top trend line once again at a new high of 55.50. Steepness of the ascent in the latter stages was unsustainable. The peak looked like a one-day reversal, with a close near the low of the day and a tall daily price swing. However, volume was unconvincing. It was higher that day than during the prior week, but it certainly was not of the caliber of the late November spike. In any case, the stock tumbled and soon reached a new low of 43.50, stopping right at the bottom trend line. Once the stock began moving higher, the momentum players jumped on board and volume increased along with price. Buying enthusiasm and rising momentum pushed the stock higher, climbing through the top trend line. An upward breakout occurred. Throughout the various peaks and troughs as this chart pattern unfolded, there was a struggle between buyers and sellers. Near the lows, the buyers believed the stock was oversold, and they eagerly bought it. At the top, they and others sold their shares and pocketed handsome profits. This selling pressure, of course, sent the stock back down. Some investors, seeing the stock decline below their purchase price and still believing that the stock had value, bought more. That behavior also helped turn the stock around at the lows and probably explained their heightened nervousness at the top. Wanted to keep their gains this time instead of watching them evaporate should the stock decline again. The broadening top shown in the figure also makes evident that identifying the ultimate breakout is difficult. It appears that each new high or new low may be the final push to freedom. Only when price moves in the opposite direction is it clear that price will not break out. We explore ways to profit from that behavior in the trading tactics section. Identification guidelines. Table 11.1 shows the identification guidelines for the broadening top. Appearance. The pattern looks like a megaphone with price peaks and valleys bounded by two diverging trend lines. The top trend line slopes upward, and the bottom one slopes downward. Price trend. The price trend leading to the start of the pattern is what differentiates a broadening top from a broadening bottom. For broadening tops, the price trend should be upward, leading to the chart pattern, not downward as in the broadening bottom. This is just an arbitrary designation I have chosen to distinguish tops from bottoms in all chart pattern types. Trend lines. Trend lines drawn across the peaks and valleys resemble a megaphone. Higher highs and lower lows make the formation obvious to those versed in spotting chart patterns. The slope of the trend lines is what distinguishes this chart pattern from others. The top trend line must slope up and the bottom one must slope down. When one of the two trend lines is horizontal or nearly so, the formation becomes a right-angle descending or descending broadening formation. When the two trend lines slope in the same direction, the formation is a broadening wedge. Touches. There should be at least 5 touches of the trend lines, 2 on one trend line and 3 on the other, but be flexible. 5 or more minor high or minor low touches makes for a well-formed pattern. Fewer touches than 5 often leads to incorrectly identified patterns. Avoid counting it as a touch when price slices through a trend line, no minor high or low involved. That's common at the start and end of the broadening pattern. Figure 11.3 shows an example of this on both ends of the bottom trend line. The trend line cuts through price and does not rest on a minor low, so it doesn't count as a touch. Figure 11.3 shows a U-shaped volume trend. Volume is higher in September and December and lower in the intervening months. Orthodox broadening tops and 5-point reversals describe the same type of pattern. They are simply broadening tops that have 3 minor highs and 2 minor lows. Figure 11.3, for example, falls into this category. Other than the name, I found no substantial difference between broadening tops, orthodox broadening tops, and 5-point reversals. Some analysts say 5-point reversals are bearish indicators and that the formation predicts a downward breakout. A study of the pattern, admittedly using only 30 samples, suggests this is untrue. 16 break out upward and the others 14, but check my math break out downward. However, the sample size is too small to make a definitive statement. Focus on failures. What does a broadening top failure look like? Figure 11.3 shows a sharp downward breakout day thrust that pierces the bottom trend line on high volume. Since this is clearly below the lower trend line, and coupled with the failure of price to attain the upper trend line, a partial rise, a downward breakout is at hand. The downward plunge is like a mountain climber hitting a ledge. Price stalls on very high volume, recovers, and starts climbing again. This is an example of a 5% failure. That is, price breaks out and then moves no more than 5% in the direction of the breakout before moving substantially in the other direction. Contrast the behavior shown in Figure 11.3 with that shown in Figure 11.4. I include this chart because I have noticed that a large number of broadening formations act this way. Instead of making a clear up or down thrust that pierces the trend line, price moves horizontally for months before finally closing above or below the formation highs or lows. In this case, price declined below the low in early July and halted the last trendline touch at pattern's end. Price climbed for a bit, then receded again and reached a new low in early August. It looks as if price vaulted over the August volume spike. Another recovery saw price rise no higher than 44 for about half a year before finally staging an upward breakout. The breakout happened when price closed above the top of the chart pattern. The sideways move isn't a 5% failure, but it tries the patience of traders waiting for something to happen. Statistics. Table 11.2 shows general statistics for this chart pattern. Number found. I uncovered 2424 broadening tops in data from July 1991 to November 2019 in 873 stocks. Not all stocks covered the entire time, and some of them no longer trade. Reversal R, continuation C occurrence. By definition, since we are dealing with a top, an upward breakout is a continuation, and a downward breakout means a reversal of the prevailing upward trend. Average rise or decline. I compared the average rise or decline with the average for all chart pattern types and found that the broadening top underperforms in all market conditions, bull/bear and breakout directions, despite what you see in the table. Standard & Poor's 500 change. Notice how the general market helped or hindered price. The numbers, when compared to the average rise or decline, suggest trading with the market trend, bull market, upward breakouts and bear market, downward breakouts for the best performance. This makes intuitive sense. Days to ultimate high or low. The time it takes price to rise to the ultimate high or sink to the ultimate low varies from 253 days, about 8.5 months, to 37.5 weeks. I compared the average speed of price for upward versus downward breakouts in bull markets. The decline should have taken 79 days, but the average is 56 as shown in the table. Thus, price drops faster than it rises. In this case, it's not quite twice as fast, which is what I've seen in other chart pattern types. Comparing the two bear market columns, we see price rise 25% in 91 days and drop 22% in 37 days. If price dropped as fast as it climbed, it should have taken 80 days to drop 22%. In this case, price drops more than twice as fast in bear markets as it rises. How many change trend? This is a measure of how many broadening tops see price move more than 20% away from the breakout price. I like to see values above 50%, but only one of the columns qualifies. Table 11.3 shows failure rates for broadening tops. I found that 18% of broadening tops in bull markets after upward breakouts fail to see price rise more than 5%. That's how you read the table. Here's another example. Just over half, 52% of patterns in bull markets with downward breakouts fail to see price drop more than 10%. Notice how quickly failure rates increase. Bear markets with downward breakouts have the lowest failure rate initially, 9%, but the edge over bull markets with up breakouts does not last long. For moves of 15% and higher, bull markets with upward breakouts maintain a lower failure rate. How is this information useful? Imagine that the measure rule predicts price will climb from 40 to 50, a 10-point rise. That's a move of 25%. How many broadening tops in bull markets, on average, will see price rise more than 25%? Answer: 46%. To put it another way, 54% of them will fail to see price rise more than 25%. Table 11.4 shows breakout-related statistics for broadening tops. Breakout direction. In bull markets, price breaks out upward most often. In bear markets, the breakout direction is random. Yearly position performance. I sorted the breakout price into one of three bins. Upward breakouts show the best performance when the breakout price appears in the middle third of the yearly high-low price range. Downward breakouts favor the lowest third of the range, throwbacks and pullbacks. A throwback or pullback occurs about 2/3 of the time, and it takes 11 or 12 days to complete the trip back to the breakout price, on average. In all cases when a throwback or pullback occurs, performance suffers. To avoid a throwback or pullback, look for nearby support or resistance that is strong enough to turn price back. Good luck with that. I've not been able to predict whether a throwback or pullback will happen. I just assume they will and go from there. If they don't appear, I'm as happy as a kid with a bag full of candy on Halloween. You might try looking for overhead resistance or underlying support within 5% to 11% away from the pattern. Those percentages are averages of how far price travels in 6 days, according to the table. Gaps. Sometimes a breakout day gap helps, and sometimes not. Downward breakouts have results that are 1 percentage point apart, so they may not be statistically significant. Upward breakouts see better performance if a gap is absent. That's counter to normal trading wisdom. Other chart patterns see performance improve if a gap occurs. If you want to participate in a gap trade, know that I measured performance using the opening price the day after the gap, so you can buy a stock after it shows a gap, and maybe you can participate in the better performance. Table 11.5 shows statistics related to size, height. In all cases, tall patterns see better post-breakout performance than short ones. To use this finding, measure the pattern's height from the highest high to the lowest low. Divide the difference by the breakout price. For upward breakouts, it is the highest high in the pattern. For downward breakouts, use the lowest low. Then compare the result with the median shown in the table. A result higher than the median means you have a tall pattern. Lower means a shorter pattern. For best results, select tall broadening tops and avoid short ones. Width. In 3 of 4 contests columns, wide patterns see better post-breakout performance than do narrow ones. The one exception happens in bear markets after upward breakouts. I found it odd that bear market, up breakout percentages for height and width are the same. I checked my spreadsheet, and the information is correct. To use width as an indicator, compute the time from the end of the pattern to the start in calendar days, not price bars. If the result is more than the median listed in the table, then you have a wide pattern. Height and width combinations. Table 11.5 shows the performance results after combining the characteristics of height and width. Most of the time, tall and wide patterns show the best performance. In bear markets after downward breakouts, short and wide patterns outperform. That's probably a statistical fluke, and the percentages are close anyway. Table 11.6 shows volume-related statistics. Volume trend. Volume trends upward from 66% to 73% of the time on average. However, don't throw away a trade because the pattern has a downward volume trend. Try to recycle. Rising/falling volume. Half the time, the volume trend doesn't really matter to performance. In bear markets, we see a wider separation of results. For example, after upward breakouts in bear markets, price averages a climb of 27% compared to just 19% for patterns with falling volume. The sample counts, 146 versus 54, respectively, are not as robust as I like to see, so the results may change. Breakout day volume. The broadening top is a rebel. It doesn't conform to common wisdom about heavy breakout volume, which is, heavy breakout volume helps performance. As the table shows, sometimes it helps, sometimes it hurts, and half the time it can't make up its mind. However, as a general rule, you should see improved performance probably meager if breakout day volume is above the prior 30-day average. I added table 11.7 to this edition to highlight where price might stop on the way to the ultimate high or low. For example, I found that 79% of the time, price will return to the top of the pattern after an upward breakout. You'll likely be stopped out a lot if you choose to place a stop-loss order there. Place a stop at the bottom of the pattern, and a stop-loss order will be hit less than 5% of the time, on average. However, the size of the loss after an upward breakout could be large, so do consider the size of the potential loss before deciding where to place a stop. Table 11.8 shows how the chart pattern performed over 3 decades. This table only shows bull market numbers because bear markets only happened in the 2000s. Performance over time. Upward breakouts saw the best performance and downward breakouts saw the worst performance in the 2000s. That makes sense. If the market is rising after an upward breakout, those patterns with downward breakouts will struggle to see price drop. It's like trying to swim against the current. Failures over time. Failures have increased over the 3 decades for both upward and downward breakout directions. That's not a good omen for future performance. Table 11.9 shows busted pattern performance. See the glossary, busted pattern, for details on what a busted pattern looks like and how to spot one. Don't forget your binoculars. Busted patterns count. Almost half, 47% of broadening tops will bust in bull markets after downward breakouts. Notice that the fewest busted patterns happen after downward breakouts in bear markets. There you have the market current downward carrying a long price as it drops after a downward breakout. The sample count, at 30, is tiny compared to the sum of the others. Busted occurrence. I counted the types of busts, single, double, or more than two, and found that single busts happen most often. In second place for downward breakouts is triple or more busts, busted and non-busted performance. I compared the performance of all busts, 1, 2, and triple plus, with single busted and patterns that don't bust, non-busted. Busted patterns outperform when the busted breakout direction matches the market trend upward breakout in bull markets and downward breakout in bear markets. Recall that after upward breakouts in bull markets, the stock will bust by dropping. So the stock is heading down and showing better performance too, even as the general market is rising. The same applies to busted downward breakouts, price rises in bear markets, many stocks drop. Why does this happen? My only guess is that stockholders know a good or bad situation when they see it and trade with enthusiasm, in spite of what's happening in the general market. Trading tactics. Table 11.10 outlines trading tactics for broadening tops. Measure rule. The first thing to consider about trading tactics is the measure rule. The measure rule predicts the price to which the stock will move in theory. For many chart patterns, one simply computes the height of the chart pattern and adds or subtracts the height from the breakout price. Apply the same method to broadening tops. Consider figure 11.5 as an example. The height of the broadening top is the difference between the highest high B, 12.13, and the lowest low A, 10 or 2.13. For upward breakouts, add the height to the highest high in the chart pattern, giving a target of 14.26, as shown in the figure. For downward breakouts, subtract the height from the bottom of the pattern, giving a target of 7.87. If the computation gives a target below 0, then don't use the measure rule. If the target is too far away, 21% in this case, there's a good chance price won't drop that far. Use common sense. The bottom portion of the table shows how often price reaches the measure rule target. For the full height, as in our example above, bull markets, upward breakouts, price will reach the target 66% of the time. You can adjust the height to get different targets that may be easier or harder for price to reach. Once you know the target, read the text associated with Table 11.3 to see if the potential move is reasonable. How do you make use of the measure rule? Imagine that you are considering purchasing the stock. Try the following tips, go long at the bottom. Since a broadening formation should have 5 touches, 3 on one trend line, 2 on the other, before it becomes valid, point A, in figure 11.5 shows one likely investment location. Before placing the buy order, compute the target price using the measure rule. The target price will help you determine if the potential gain is worth the risk. In the example shown in figure 11.5, the purchase price is about 10.38 at A, and the target price is 14.25, a 37% move. The stop loss should be 9.85, 15 cents below the low at A, for a potential loss of 5%, which gives a reward-to-risk ratio of 7 to 1, more than enough to risk a trade. Long stop. Buy the stock soon after it touches the lower trend line and moves higher, after the pattern has fully developed following the identification guidelines. Place a stop loss order 15 cents below the lowest low, 0.15 below point A. Should price drop, your position will likely be sold before a large loss occurs. Price climbs across the pattern. Be ready to sell once price reaches the prior minor high. Confused? Look at figure 11.3. On the way to point 5, be prepared to sell as the stock climbs to the price of point 3. Price may pause for a bit before moving higher and tagging the top trend line, or it may reverse at this point, which it does in figure 11.3 at point 5. Make sure your stops have been raised to protect your profits. Go short at the top, short stop. For short positions in broadening tops, open the short after price touches point B, figure 11.5, and begins heading down. Place a stop 15 cents above the highest high, 12.28 in this case, to limit losses. Lower your stop to the next minor high or apex of the broadening top, either 11.88 or 11.13 in figure 11.5, once the stock nears point A. Sometimes the stock will not make it down to the trend line before beginning to move up. At other times, there is a lengthy pause before price turns around or continues down. A lower stop-loss point helps you achieve at least some measure of profit. Partial rise and decline. Partial rises and declines are like deer in mating season when you're driving. Look out for them. See the glossary, partial rise or partial decline, for details on spotting the pesky critters. When you see a partial rise or decline, place a trade once the stock reverses course. If a breakout happens, then consider adding to your position. Using a partial rise or decline to enter a trade before the breakout is a reliable trading technique. You get in at a better price, and they accurately predict the breakout direction. Stop location. Use table 11.7 for guidance on stop placement. Busted trade. Consult table 11.9 for tips on trading busted patterns. If you are lucky enough to trade a single busted pattern, you can make a lot of money. Experience. Let me tell you about what I found in my trade review. Advanced Micro Devices Inc. Advanced Micro Devices Inc. AMD formed a broadening top in the first half of 2001. Here's my notebook for the trade entry, 2 August 2001. I bought at the market, filled at 19.64. The stock has bounced off the bottom of a broadening top. I hope prices will race across the pattern, but expect them to stall at 22 with eventual push to 25. Downside is old low at 16 or lower boundary. Upside is 25 with possibilities of a climb into the high 30s. Resistance at 22, 25, 30. I expect a climb to 25 where it may be time to sell. Book score is +1, assuming an upward breakout. The book score is based on my book, Trading Classic Chart Patterns, which describes a scoring system to help improve selecting patterns that outperform. In this case, it didn't apply because the breakout was downward. Notice that I didn't dwell on the potential loss in percentage terms. Had I pondered that, I might have avoided this losing trade. Lesson: don't forget to assess the potential loss and avoid the trade if the loss is too high. I bought the day the stock peaked. It dropped from there and soon was at the chart pattern's bottom trend line and dropping below it. Here's my notebook, 15 August 2001. I sold at market. Fundamentals have changed, with IBM saying they will no longer buy AMD-based computers because customers prefer Intel. The stock has completed a partial rise and is expected to break out downward from the broadening formation. Yesterday, the stock closed below the 16 stop price, so it was time to sell. With September and October approaching, it's probably wise to exit the market. On the other hand, I don't really see the stock going much lower and expect that I sold near the bottom. In fact, the stock continued lower. Much lower. I sold at 15.70 for a 20% loss, but the stock bottomed at 7.69 or 51% below my sale price. As big as my loss was, I'm glad I sold. Looking at the chart for the buy, the stock was well away from the bottom trend line, moving higher at a brisk pace 6 days in a row. It made a higher high. Maybe that was an indication of weakness. How long can the stock continue such a strong push upward? Perhaps running the chart through a momentum indicator would have provided a clue to the underlying weakness. In this trade, I entered late but made a perfect exit on the day price broke out downward. Lesson: before buying, don't be afraid to use technical indicators to uncover a weakening trend. Chico's FAS. The 2009 bear market ended for Chico's FAS CHS in January, and the stock moved higher, ahead of the general market, which didn't bottom until March. In June and July, the stock took a breather and formed the broadening top. I bought at what looks to be about a week before the breakout, just as price moved sideways at the top of the pattern. 24 July 2009. Buy reason, broadening top. New management took over in January-February, so a turnaround is in place. This was a buy and hold stock because I wanted to participate in the turnaround. Upside target was 17 and 27. The downside. Stop 8.9 for 17.5%. Stop used none. Long-term holding, but 8 is a good exit price. The stock performed, moved up in a graceful turn, and peaked at 16.57 on 26 April 2010, quite close to my 17 target. I should have sold there. The stock was just 2.6% below my target, having made it there in less than a year. Hindsight. Lesson: if the stock closes within 3% of the target, consider selling. The day the stock peaked, I placed a conditional order to sell the stock if the previous close was at or below 13.73 by October 2010. The order was 17% below the current high, but that's fine for a buy and hold, which often doesn't use stops at all. About 3 weeks after the stock peaked, the company announced earnings that the market didn't like. The stock gapped open lower and continued down. Here's where the story gets strange. The stock dropped all the way back to 8.22 on 24 August, a 50% drop from the peak, but the conditional order never triggered. I must have removed the order but never made a note of it. On 5 July, I wrote this. This is well past the time to sell, but since I have so few bucks in it, don't worry about it. So the stock was within a handshake of my target and then dropped in half. Oops. I am tempted to write that I wasn't paying attention, but I was. I placed the conditional order the day the stock peaked, so my mind was in the game. Anyway, fast forward to March 2012 after the stock had recovered and made what looked like 2 rounded turns. I placed a trailing stop at 1 point below the bid, GTC, good, till canceled, until 1 July 2012. 2 weeks later, I canceled the trailing stop of 14.64 and raised it to 14.91 because I think this is going to drop. It's a good earnings event pattern, and I don't want to ride it down a buck before it moves higher. Stop placed just below support. 4 days later, I was out of the stock. Sell reason, hit stop. I was worried that the overhead resistance area would repulse shares and send the stock down after the good earnings event. I didn't want to ride it back down. My guess is this will drop, but not much, before resuming the up move, providing the market moves higher. It has been but just by a little each day. If the market drops, which I expect, it should take this stock lower too, but so far, I've been waiting for the general market to tank, and it hasn't. The stock did continue lower, but only by 9% below my sale price. The stock peaked about a year later at 19.95, before sliding all the way down below 1 in April 2020. I made 42% on the trade, including dividends, but it took just over 2.5 years to do that. However, that's almost 16% a year, which is quite good. This lesson is worth repeating though. Lesson: if the stock closes within 3% of the target, consider selling. Southwest Airlines. Southwest Airlines, LUV, made a broadening top going into 2001. Prices in the following notebook entries have not been adjusted for the 32 stock split. On 26 January, I bought at the market on a broadening top. Price is at the lower trend line but moving up. The company is successfully hedging their fuel costs. I expect oil prices to decline, Federal Reserve to ease interest rates next week, and economy to slowly rebound. I actually think this will be a loser trade, but broadening top chapter in new book says it is a strong candidate to buy. I expect a partial rise with downside breakout. Upside is formation top at 35, downside is stop loss at 27.30, call it 27.25 for a 10% decline. If it closes below 28, that is sell signal, dump immediately, filled at 30.39. I didn't buy exactly at the bottom of the broadening bottom, 28.20, so that's something I can improve on. Lesson: try to buy as close to the optimum entry price as possible, the lower trend line in this case. The stock continued to move higher, but halfway up the chart pattern, it stalled. That's common and wasn't a cause for concern until price started backtracking. 12 February 2001. I sold at 31.18 because of a partial rise on the broadening top. Since I believe this is going down, there was no sense to wait for it to close below 28 before dumping. I made a small profit, about 2.5%. For a swing trade, I got in late and exited late too, hurting the profit margin. Looking at the chart, the picture looks like a head and shoulders top. The partial rise is the right shoulder, and it's at the height of the left shoulder. I should have been prepared for the stock to turn lower there because of the mirror on the left side of the pattern. Lesson: as price moves, pay attention to the surrounding price landscape for clues to how the stock may behave. Look for support and resistance areas where the stock might reverse. Lesson: play with price mirrors. Price mirror: pick a vertical turning point on the price chart and reflect the left side of the chart onto the empty right side. The peaks and valleys on the right, in the future, might match the ones that happened in the past. It's better than sex when it works, and it gives you some idea of what the future could bring. For example, if you were to flip the chart across the head of a head and shoulders top, you'd see that the right shoulder will match the distance and price of the left shoulder. You can continue the analysis for the rest of the chart, too, giving both price and time on the turns. Sample trade. If you wait long enough, Sandra sold me, you get rewarded. My stomach growled. I was wondering if she'd reward me with a meal. She's a terrific cook. Instead, she pulled up figure 11.5 on her computer screen. 2 days after the stock bottomed, at A, I bought at 10.50. I placed a stop 15 cents below the bottom of the pattern, below A, for a potential loss of 6%. She applied the measure rule and was looking at a target of 14.25. If everything worked as expected, that would give her a profit of over 35%. When price paused here, she pointed near the start of the flag, I wondered if the trend was going to reverse. I thought about cashing out and running to the bank, but didn't. I decided to drive. She winked at me and smiled at her pun. The flag formed, and I hoped it would be a half-staff pattern, meaning the flag was halfway up the move. If that were true, she could expect a climb to 13.25. That is the distance from the top of the flag, 12.13, to the start of the move at 10.00 projected upward, using the lowest low in the flag at 11.13. A few days later, the stock not only fulfilled the measure rule for the flag, but for the broadening top as well. Did you sell? No, why not? Because the stock was moving up, I decided to let my profits ride. However, I did raise my stop to 11.85, which was below the top of the flag and also below the high at B. I thought it was a support area and hoped the stock would rebound before taking me out. In mid-February, just after the second peaked at 17, I saw a potential double top pattern. I raised my stop to 15 cents below the double bottoms confirmation point, or 14.25. About 2 weeks after raising her stop, her position sold when the stock plunged from the prior close at 15.63 to 12.13. After commissions, she made 33% in less than 4 months. My stomach growled again. Yes, I'll feed you. I make this killer Swiss cheese, macaroni, and veggies casserole, lightly topped with toasted breadcrumbs. It has enough carbs to power the city. Let's go. She grabbed my hand, towed me to her kitchen, and handed me a carrot peeler. What's this? I asked. End of chapter 11. Chapter 12. Broadening wedge. Ascending. Results snapshot. Appearance: price follows 2 up-sloping trend lines that diverge. The results snapshot shows statistics for the ascending broadening wedge. Since the pattern is so rare in bear markets, I limit discussion to bull markets only. Upward breakouts show a rank that's mid-list, but downward breakouts show performance near the bottom of the list of all chart patterns. Notice how the failure rate for downward breakouts, 31%, is twice that of upward breakouts, 15%. It sends a shiver down my bones. Downward breakouts in bull markets have failure rates 31%, well above the average 24.7% of all chart pattern types. If you're expecting a big drop after this pattern breaks out downward, then you'll be disappointed. Of course, that's based on the average performance drop of 12%, so your pattern may perform differently. For the glass half-full crowd, you can buy a busted downward breakout, and there's a good chance it'll single bust, meaning a higher profit potential when price rises. The rise after an upward breakout, 41.1%, is slightly below the average for all chart patterns, 42.4%, so even upward breakouts see price struggle. Let's take a tour of this pattern first and crunch the numbers later. Tour. What does an ascending broadening wedge look like? Consider the chart pattern in figure 12.1. The first thing to notice is the two sloping trend lines. The top line has a slightly steeper slope than the bottom one. Together, the two lines diverge but both slope upward. Once price pierces the bottom trend line, it drops rapidly in this example. The chart looks like a long, pie-shaped wedge that slopes uphill. The uphill tilt is why it is called an ascending broadening wedge. Price bounces up and down and is contained by two diverging trend lines. Figure 12.2 shows a better example of a broadening wedge. Why better? Price crosses from down to up plenty of times, and it looks tighter, with the swings closer together than in the prior chart. Both figures 12.1 and 12.2 show a similar situation. The chart pattern appears at the end of a rising price trend and signals a reversal. Although a reversal is not always the case, nor is the chart pattern required to be at the end of a rising price trend, both situations occur more often than not. Figure 12.2 also shows an interesting pattern that is instrumental in identifying the start of a new price trend, the partial rise. Near the end of the wedge, after touching the lower trend line, price again moves up but fails to touch the top trend line. As price descends, it pierces the lower trend line and continues moving down. That's how partial rises are supposed to work. Price should approach, but not come that close to, the top trend line before heading back down and making an immediate downward breakout. The chart also shows a similar situation that occurs earlier in the price pattern, shown on the chart as failed partial rise, around the start of the year. Price has touched the two trend lines at least 5 times, so it looks like a valid and established ascending broadening wedge. Price rises in its attempt to touch the top trend line but fails. The trend heads down and forms a partial rise, right where you'd expect it to form, at the pattern's end, as of that date anyway. If the partial rise worked, we should see an immediate downward breakout. Oops, it doesn't happen. Price bounces off the bottom trend line and zooms up to touch the upper trend line, forming the tallest peak in the pattern. Why does a broadening wedge form anyway? Pretend that you are the head of a mutual fund that has big bucks to spend and wants to buy shares in another company. When the price is low, you instruct your trading department to begin buying. The sudden buying demand forces price to climb even though the trading department spreads its orders over several days. The trading department tries to keep its buying quiet, but word gets out that you are in the market. The momentum players jump on your coattails and ride the stock upward by buying too. This sends the stock higher than you expected, so your trading department stops buying for the moment. Value investors and swing traders, sensing an overbought situation, are willing to sell their shares at the higher price. Soon the stock is moving down again. But before it can reach its old low, the buy the dip crowd jumps in and halts the decline. Your trading department, seeing a higher low form, jumps back in and buys while the price is still reasonable. Some new traders join the hype and decide the stock is worthy of a trade and add to the buying pressure. The company itself gets into the act and buys shares authorized by the board of directors as a share buyback program announced long ago. The buyback program is nearing the expiration date, and the company feels it is the right time to buy to complete their promise to shareholders. The stock makes a new high. When it climbs high enough, selling pressure overwhelms buying demand and sends the shares lower, but the price will not drop far, not with everyone trying to buy at a good price. What you have then are much higher highs from the unbridled buying enthusiasm and higher, but saner, lows as your fund and the company itself tries to buy near a fixed low price. You never quite succeed and pay higher and higher prices as the minor lows move up. Soon, however, the stock is too pricey even for your tastes, so the trading department stops buying. Momentum players keep pushing the stock higher for a time, but selling pressure eventually takes over and the stock heads down. Everyone has an ear to the ground listening, trying to figure out what all the excitement is about. In the distance, a rumble sounds. The same-store sales numbers are going to be lower this quarter, the shorts say. The rumor finds sympathetic ears. The rumble heard earlier is the stampede of the smart money running for the exits. Price drops quickly. It may hover for a bit around support zones, while novice investors, who have not gotten the word, buy the stock. When they finish placing their orders, the meager buying demand abates, and the stock crashes through the lower trend line and heads down. Identification guidelines. There are a number of identification guidelines, outlined in Table 12.1, that make this formation unique. As I discuss the different guidelines, consider the ascending broadening wedge depicted in Figure 12.3. This formation is different from Figures 12.1 and 12.2 in that it is born from a region of consolidation. From the beginning of the study in July 1991, not shown, price moves generally horizontally and does not fall much below the 15.38 level. A portion of that horizontal move appears in the figure before the start of the wedge. The situation changes just before the new year. Price starts moving up on 23 December. The stock reaches a new high in mid-January but soon moves down. At that point, two tentative trend lines connect the highs and lows. Although it is too early to form a definitive conclusion, a broadening wedge appears to be taking shape. After price moves up and touches the upper trend line, then pulls back to the lower one again, the broadening wedge formation is clearly visible. At the start of March, price moves higher but quickly stalls, turns around and pierces the lower trend line. The partial rise in trend line penetration suggests a trend change is at hand. Price has broken out downward, but it only lasts for 3 days, moving in a tight congestion pattern that sees price zoom upward and touch the top trend line. If you're so inclined, redraw the bottom trend line to accommodate the slight decline below the old trend line. Clearly, price has more work to do before declining below the lower trend line again. A month later, price returns to the bottom trend line and moves higher for a few days. However, the rise stalls and price pierces the lower trend line. Like a replay of the price action a month earlier, price pulls back to the trend line and starts moving higher. However, this rise falters on low volume and price quickly returns to the lower trend line. When price gaps down on 16 April, another breakout, a genuine one this time, occurs. In rapid fashion, price plummets to below 12.75, nearly a 50% decline from the high. Appearance. Looking back at figures 12.1, 12.2, and 12.3, there are several characteristics that ascending broadening wedges share. The overall shape appears as a megaphone, but this megaphone tilts upward. Both trend lines slope higher. The upper trend line has a higher slope than the lower one, giving the formation a broadening appearance. Trend lines. The two trend lines outlining the wedge diverge, but both trend lines tilt upward. Touches. In my studies of ascending broadening wedges, I select formations that have at least 5 touches total, 3 of one trend line and 2 of the other. The 5-touch minimum helps identify reliable chart patterns. Each touch should be a minor high or minor low. If price cuts through a trend line, such as at the start of end of the wedge, it doesn't count as a valid touch. White space. The pattern should have price crossing from top to bottom frequently. Avoid patterns with a big chunk of white space. Volume. The volume pattern is irregular, which is common for long patterns, but generally rises as price moves up and recedes as price declines. Although it is not clear from the charts, volume tends to rise over time. However, an upward volume trend is not a mandatory selection guideline. If volume trends down, then that's fine. Breakout direction. Figure 12.3 shows a false breakout. Usually, price follows the lower trend line and does not penetrate it until the actual breakout. When price does break out, the price action can be messy, as shown in the figure. Sometimes price runs straight through the lower trend line without pausing, and sometimes it weaves around the trend line before finally continuing down. Price can break out in any direction, but leans toward a downward one. Focus on failures. Figure 12.4 shows what a failure looks like. Although price breaks out downward from the wedge, the stock fails to continue moving lower. The breakout occurs at a price of 50.13, and price drops to a low of 48.63 about 2 weeks later, resulting in a 3% decline, too small to register as a success. Any breakout move no more than 5% I consider a failure, a 5% failure. After a downward breakout, you'll often see price struggle to drop. Maybe it's because price trends upward in the pattern, both trend lines tilt up, so there's buying demand waiting under the stock to keep the uptrend going. A downward breakout smashes into that buying demand, surprising and overpowering the sellers, and price rises. Left behind is a meager drop. Of course, that's not always the case. If fundamentals deteriorate or if a large stockholder wants to dump their position now, it could send price plummeting. Swing traders and momentum players will join the fun and help push price lower. However, the numbers suggest that this chart pattern sees price struggle to drop. Indeed, 31% fail to see price decline more than 5% after a downward breakout. That's good news for longer-term holders of the stock, like buy and hold investors. If the decline after an ascending broadening wedge is meager, then why worry? Let's look at the numbers to get a better sense of how this pattern behaves. Statistics. Table 12.2 shows general statistics for ascending broadening wedges. Number found. I found the first pattern in July 1991 and the most recent in July 2019, totaling 767 patterns in 529 stocks. Not all stocks covered the entire time. After removing bear market statistics, we have a similar number of patterns with up and down breakouts. Reversal R, continuation C occurrence. Upward breakouts from the broadening wedge act as continuation patterns, meaning price trended upward into the start of the pattern. Downward breakouts acted as reversals most often. Reversal/continuation performance. Mapping performance of reversals and continuations shows that patterns acting as continuations outperformed reversals for both breakout directions. However, performance for downward breakouts is about even. Average rise or decline. The table shows only bull market statistics, so when the breakout goes against the prevailing market trend, performance suffers. Thus, it is more profitable to trade with the prevailing market trend instead of against it. That means trading upward breakouts in a rising market. Standard & Poor's 500 change. From the date of the wedge's breakout to the ultimate high or low, I checked the performance of the index. You'll notice that the index didn't fare as well as the chart pattern. You might also conclude that the general market helped boost the performance of the individual stocks. The boost was higher in bull markets, with the index rising 11%, helping to achieve a 41% average chart pattern rise. Days to ultimate high or low. Upward breakouts took their sweet time, about 8 months, rising 41%. Downward breakouts took only about 7 weeks to reach the ultimate low. Checking the two velocities, we find that downward breakouts reach the ultimate low faster than upward breakouts reach the ultimate high. How many change trend? This measures how many patterns see price rise or fall more than 20%. For upward breakouts, I consider a value above 50% good. Downward breakouts seem to always suffer under this gauge. Table 12.3 shows failure rates. How do you make sense of the numbers? Let me share some examples. In bull markets after downward breakouts, 31% of the patterns failed to see price drop more than 5%. Upward breakouts showed half the failure rate, 15%. Notice how the failure rates rise quickly as the maximum price rise or decline increases. For example, over half the patterns with downward breakouts, 57% fail to see price drop more than 10%. Upward breakouts don't reach the 50% threshold until price fails to drop more than 25%. Table 12.4 shows breakout-related statistics. Breakout direction. The breakout direction is about random but favors a downward breakout. Of course, additional samples might change this. Yearly position performance. Mapping performance of wedges onto the yearly price range, we find that upward breakouts with the breakout price within a third of the yearly high perform best. Downward breakouts do better if the breakout price is near the yearly low. Throwbacks and pullbacks. Throwbacks and pullbacks occur about 2/3 of the time, and it takes the stock between 11 and 12 days to return to the breakout price. The move between the breakout and the apex of the throwback or pullback isn't large enough, 4% or 5%, to consider a swing trade to capture the move. Other chart pattern types see price move farther away from the pattern than do wedges. I'd look at those patterns for a throwback or pullback swing trade. Notice that when throwbacks and pullbacks occur, performance suffers. Because the performance difference is wide, you'll want to avoid nearby support or resistance, which might cause a throwback or pullback to happen. Gaps. According to the statistics in the table, sometimes a breakout day gap helps performance downward breakouts, and sometimes it hurts upward breakouts. In other chart patterns, we usually see a performance boost if a gap occurs, but often the boost is minor. Table 12.5 shows pattern size statistics. Height. Height is an excellent predictor of future performance. Taller ones do best, except for this chart pattern, at least for upward breakouts. Downward breakouts perform best if the pattern is tall. Width. For other chart pattern types, wide patterns outperform narrow ones. In this case, narrow patterns with upward breakouts do well and wide patterns with downward breakouts show a minor performance improvement. Height and width combinations. Tall and narrow patterns outperform. Placing last for performance are short and wide patterns. As you would expect, narrow patterns with upward breakouts do best and tall patterns with downward breakouts outperform on average. There's a large enough swing between the various numbers that you might want to confine your trading to tall and narrow wedges. Table 12.6 shows volume-related statistics. Volume trend. Volume trends upward as measured from the start of the pattern to the end. Does the trend direction matter? Let's find out. Rising/falling volume. I sorted performance by whether volume was rising or falling in the pattern. Patterns with a receding volume trend do slightly better, but not enough to worry about. Breakout day volume. Light breakout day volume sees price move farther than heavy breakout volume. That finding goes against conventional wisdom. Light volume has only 96 samples compared to 233 for heavy volume, upward breakouts only, so it could be a sample count thing. That means more samples might change the results. Because of the way I calculate stops, Table 12.7, how often stops hit, does not apply to this chart pattern, so I left it off. Table 12.8 shows the performance over 3 decades. Performance over time. Upward breakouts show stable performance over the last 30 years. Downward breakouts had their best performance in the 1990s and the worst in the 2000s. Bear markets were not included in the numbers. Failures over time. Both up and down breakouts show an increasing tendency to fail over time. In other words, failures were lower in the 1990s than in the 2000s and lower in the 2000s than the 2010s. I don't know the reason for this, but I applaud the consistency. Table 12.9 shows busted pattern performance. See the glossary, busted pattern, for tips on determining what a bust means, and we're not talking about anatomy or sculpture here. Busted patterns count. As one might expect, downward breakouts have a substantially higher bust rate than upward breakouts, more than twice as often. That's not a bad thing if you want to go long after a busted downward breakout to capture a big rise. Busted occurrence. I told my computer to count how often a pattern busted single, double, or more than twice. Single busts happen most often. For downward breakouts, triple busts, triple plus come in second for frequency. That may sound odd, and I think it is, but it's something we've seen in other chart pattern types. Busted and non-busted performance. Is it better to trade a busted pattern than a non-busted one? Yes, but only if you can find a single busted pattern. Comparing all 3 busted patterns, single, double, and 3 or more busts, to their non-busted counterparts, the results do not show a significant performance edge. However, if you take pleasure from failure, then wait for a downward breakout from a broadening wedge to fail, drop 10% or less, and buy when price closes above the top of the chart pattern. There's a good chance, 83%, that the pattern will single bust, leaving the clouds as your goal and a gain averaging 49%. That's if you trade it perfectly and frequently. Trading tactics. Table 12.10 shows trading tactics. Measure rule targets. The measure rule for wedges is different from most other chart patterns in that it is based on the lowest low in the pattern, for downward breakouts only. As the table shows, price reaches that target 71% of the time. For upward breakouts and other downward targets, I use the height of the pattern, or a multiple of it, applied to the top or bottom of the pattern. Figure 12.6 shows two ascending broadening wedges and application of the measure rule. Both formations are well formed. The chart marks the lowest low in each wedge. The low serves as the expected target, the measure rule target for downward breakouts. The formation on the left shows price reaching the target in mid-November just as price turns. The wedge shown on the right has price hitting the target soon after the breakout. For targets other than the pattern's low, measure the height from the top of the wedge to the bottom of the wedge. For upward breakouts, add the height to the top of the wedge. For downward breakouts, subtract the height from the low at the start of the pattern. The result will be the target. The lower portion of the table shows how often this works. You can use other heights, half, 2 or 3 times the height in the computation to get targets closer or farther away. Once you have a target, convert the target into a percentage of the current price. For example, if the top of the wedge is at 50 and the bottom is at 40, the height is 10. If the current price is 50, a climb of 10 would be a 20% rise. Table 12.3 says that 46% of wedges will fail to see price rise more than 20%. If price drops, the target is 40 bottom of the wedge, and that's a $10 drop from the current price of 50. Again, that's a 20% drop. In this case, Table 12.3 says that 79% will fail to see price drop more than 20%, partial rise and decline. With most chart patterns, you'll want to wait for the breakout. An exception to the rule is if a partial rise or decline occurs. Figure 12.2 shows a good example of a partial rise. It correctly predicts a downward breakout. A partial decline works in a similar manner, except price drops down from the top trend line, returns, and breaks out upward. See the glossary, partial rise or partial decline, for details. Unfortunately, partial rises and declines look like they are taking shape during a normal pause that occurs partway across the pattern. Often, I'll see what I believe to be a valid partial rise or decline and wait for the regular breakout away. More aggressive traders or those with advanced skills may want to trade partial rises and declines to get into trouble sooner. Busted trade. If you can tell when a stock will single bust, or if you just take a chance that it'll single bust, you can make more money trading the stock using a busted pattern. Downward breakouts single bust 83% of the time on average, so you've a good chance of trading a winner when it single busts. With the new trend direction being upward, the potential gain is higher than for a downward move, as in a downward breakout or a busted upward pattern. When price busts the downward breakout by closing above the top of the pattern, buy the stock and ride it to heaven. Experience. Ascending broadening wedges are rare enough that I don't look for them to trade, and their performance isn't great either. However, I made one trade in Assurant Inc. AIZ that I want to tell you about. It uses a wedge. I picture the trade in figure 12.5. The wedge at A has 5 touches of the top trend line and 3 or 4 on the bottom. Price crosses the pattern enough to fill most of the white space. However, there's a big white space area between September and November, but that's because the pattern is so tall, it takes time for price to cross from top to bottom. The two trend lines slope upward and diverge as you would expect from an ascending broadening wedge. I traded this stock by entering it for the first time after the bear market ended in 2009 and sold in 2010. At E is another buy location, so I was familiar with this stock. For this trade, I bought at B. Here's my notebook entry, 24 November 2012. This is at the bottom of an ascending broadening wedge. I am flush with cash but have 15% in insurance COs. I'll add more to bring it up to near a full investment. Buy at market open on Monday. Buying at a good price at support chart pattern. 2 days later, when the market opened, I bought at the open and received a fill at 34.18. As you can see, I made a perfect entry, just 3 days after price bounced off the bottom trend line. You probably can't see the price action well enough in the printed figure, but the stock did not break out downward. A downward breakout, as you know, requires price to close below the bottom trend line, and that didn't happen. Rather, an upward breakout happened at C. This is one of those fire and forget type trades where you just sit back and count your winnings. Price took a week or so to gather strength before it started to move up after I bought. It retraced a portion of the move and bottomed at F, but after that, it was a smooth ride to the stars. Fast forward to January 2014. The stock peaked a nickel below 69 and retraced. The spike down at G was because of earnings. Apparently, the market didn't like the news but recovered to close the session just 6 cents below the high. That was my wake-up call. On 12 February, I wrote this in my trading notebook. I sold the rest of my shares this morning. The stock has broken down through a support area at 64, and it's trading at 63.42 now. On the weekly scale, this is a 2B pattern. It looks as if it's going to tumble, and since it's above my target price of 56, I did well. Selling on 2B weakness. A 2B pattern isn't covered in this book, and looking at the weekly scale, it's not a 2B pattern at all. A 2B happens when price moves above a prior peak and then poops out. The stock reverses and moves lower. Think of a narrow double top with a slightly higher right peak, and you'll know what a 2B looks like. In this case, there is no first peak to compare against. However, the note about weakness is clear. The stock peaked at almost 69 and was now trading at 63. I received a fill at 63.42 for a gain of drum roll, please, 87%, including dividends with a hold time of 15 months. I sold near the bottom of a retrace. The stock climbed back up to 69.26 and then moved sideways until July 2015. It moved sideways after I sold for longer than I was in the trade. What did I do wrong? Entry was perfect. The exit was late. The only thing I can think of to improve the exit was to use a trend line connecting F, H, and I on the log scale. This chart appears to be on the linear scale. I would have sold at the open the day after at 64.29, a slight improvement. But the trend line uses hindsight. A trend line would have taken me out any number of times on the way from F to H because price curves to the right. Sample trade. I work the night shift at a bakery a few streets away. I can walk to work, so it's handy. Before I go to sleep, I check my favorite stocks and found an interesting one shown in figure 12.6. Let me tell you about it. Each day before Curtis bedded down, he plotted the stock and watched with amusement as the first broadening wedge formed. When the second one appeared, he stopped yawning and moved closer to his computer screen. The second broadening wedge didn't excite him. Rather, it was the wedge coupled with a potential double top. Together, they looked especially bearish. The day after the stock closed below the lower trend line of the right broadening pattern, he sold short and received a fill at 39.50. I used the double top measure rule to estimate my price target. With a top at 45.75 and a valley low of 36.25, the target was 26.75. That is 45.75 36.25 subtracted from 36.25. I placed an order to cover my short at 27.13 because you always want to have protection. I put it just above the whole number and just above where everyone else was likely to place theirs. Let them get cashed out first before me. He went to bed. Each day, before he closed the curtains to get some sleep, he checked the stock. To him, it was pleasing to see the stock begin moving down immediately and sailing below the nearest broadening wedge target, 38.88. I lost some sleep worrying about the upward retrace in March and thought the party was over, but I stuck with it. The stock eventually pierced support and kept moving down. I hoped that the congestion region in March was the corrective phase of a measured move down. That would place the target at 22.50, well below my target of 27.13. I'm not stupid and I'm not greedy, so I left the target where it was. On April 18, a ringing phone woke him. His broker reported that they covered the short at his target price. He made about $12 a share. That put a smile on his face, and he went back to his dream of telling his boss what he could do with the night shift. End of Chapter 12. Chapter 13. broadening wedge, descending. Results snapshot. Appearance, price follows two down-sloping trend lines that diverge. The descending broadening wedge has performance that gravitates toward the bottom of the list of chart patterns. However, it does have one redeeming quality. Almost half, 47% of downward breakouts will bust, and of those, 75% of them will single bust. The average rise for single busted patterns is, drum roll please, 65%. That's huge. The computation uses 75 samples, and the median rise is 44%. Half the patterns will see price rise more than 44%. The results are something to look forward to. Let's take a tour, look at the numbers, and see if we can figure out how to trade these patterns. Tour. What does the formation look like? Figure 13.1 shows a well-formed descending broadening wedge bounded by two trend lines. In September, the stock starts down in tight oscillations that broaden over time. A month later, two trend lines drawn across the highs and lows make the descending broadening wedge shape clear. Volume at the start of the pattern is well below normal. As the wedge develops, volume is erratic, but trends higher. Computing the slope of the volume line using linear regression confirms the result. Volume is increasing. Usually increasing volume helps propel a stock upward. I like to see that in my trades as price rises to the ultimate high. In mid-October, price gaped up breakaway gap and shoots above the upper trend line. An upward breakout occurs. Volume spikes and continues to be heavy for several days as price climbs. As you look at the chart, you may make an interesting observation. The price trend has three stages. The first stage is the long bull run to August 1995, leading to a 2-month retrace, second stage, and then price moves higher, third stage. I show those stages in the figure by arrows. This broadening formation acts as part of a consolidation or retrace of the upward primary trend. Price enters the pattern from below and exits out the top. Taken as a whole, it looks like the corrective phase of a measured move-up chart pattern. Contrast Figure 13.1 with Figure 13.2, where a descending broadening wedge acts as a reversal of the intermediate-term price trend. Price peaks in May 1992 and heads lower. During August, price begins to broaden out as the stock continues its downward spiral. By mid-September, a descending broadening wedge has formed. Volume is low at the start of the wedge but does have a few spikes. Into September, volume moves up and becomes even more irregular. At the start of October, as price begins rising, volume recedes. Price pierces the top trend line on negligible volume and heads higher. A trend reversal from down to up occurs. Identification Guidelines Table 13.1 outlines identification guidelines for the wedge, and Figure 13.3 shows another example of a descending broadening wedge. Appearance. Minor highs align themselves like magnets to iron along the top trend line. The trend line slopes downward. Minor lows follow a down-sloping trend line along the bottom. Together, the pattern looks like a megaphone tilted down. Trend lines. The figure shows two down-sloping trend lines that encompass a series of oscillating waves. The oscillations become more violent, swinging up and down in wider and wider arcs, leaving behind diverging trend lines. Touches. Each valid trend line touch should be a minor high or a minor low, or it won't count as a touch. That means a touch does not count at the start or end of the pattern if price straddles the trend line, if no minor high or low appears there. Look for at least 5 touches, 3 on one trend line and 2 on the other, but they need not alternate. Use the figures in this chapter as guidance. White space. Price should cross the pattern from top to bottom so that it covers the white space with movement. Too much white space in a pattern means you've probably made an identification mistake. Volume. The volume trend is upward 2/3 of the time in descending broadening wedges. Increasing volume seems to catapult price higher, sending it out the top of the wedge. Volume at the breakout is usually high but need not be. As long as demand exceeds supply, price will rise. If volume recedes, don't discard the pattern. Breakout direction. The breakout direction is upward 72% of the time. All of the figures in this chapter show an upward breakout. A downward breakout would occur when price closes below the bottom trend line. Focus on failures. Look at figure 13.4. In the week or two before the wedge begins, price is rising. Immediately after the breakout, price is also rising, so this wedge acts as a continuation of the upward price trend. The breakout process starts on 3 September when price punches through the top trend line and closes above it. However, price does not rise far before returning to the trend line. I have extended the top trend line in the figure to highlight the throwback. You see that price rides along the top trend line, following it lower until it gaps down a breakaway gap on 17 September. This wedge is an example of what I call a 5% failure, that is, when price breaks out and moves no more than 5% before reversing. This type of failure is common, happening between 18% upward breakouts and 35% downward breakouts of the time. Why these failures occur is unclear. Sometimes nearby, overhead resistance to an upward breakout or underlying support to a downward thrust will repulse price and cause a failure. Traders change their minds about a stock and bolt for the exits, causing price to move in an unexpected direction. If the general market makes a sudden move, such as a large drop, it'll suck the life out of upward breakouts. If news comes out that oil prices have spiked, the industry may suffer and that pain gets reflected in the stock. And of course, if a cherished CEO gets caught with his hands in the cash register, that may cause problems too. General market, industry, and stock trends all play their part in causing a 5% failure. Statistics. Table 13.2 shows general statistics for the descending broadening wedge. Number found. I sifted through my databases searching for this pattern and found 1,011 from July 1991 to June 2018 in 565 stocks. This is not an easy pattern to find, and it's rare enough that I removed the bear market patterns because I found too few. Not all stocks covered the entire period and some no longer trade. Looking at the numbers, you can see that upward breakouts happen reversal R, continuation C occurrence. The table shows that upward breakouts act as reversals most often and downward breakouts act as continuations. However, the numbers are close to random. Reversal/continuation performance. I sorted wedges by behavior, reversals, and continuations, and checked performance for each. Downward breakouts show no performance difference, but upward breakouts give a slight edge to continuations for better performance. Average rise or decline. Both the average rise and average decline are below what we see for other chart pattern types, so this chart pattern is not one you'll want to brag about. However, the next table will discuss failure rates, so perhaps we should wait before passing judgment. Standard & Poor's 500 change. I computed the change in the S&P index using the dates when the wedge broke out and reached the ultimate high or low. As the table shows, the index didn't perform as well as the wedges. You might also consider that the general market helped wedge performance, a rising tide lifts all boats type thing. Days to ultimate high or low. I compared the 39% rise in 218 days to the 13% decline in 54 days. If the velocity of the two moves were the same, the downward move should have taken 73 days. It completed the move in 54 days. In other words, the downward move is about 50% faster than the upward one. How many change trend? This is a measure of how many wedges see price move more than 20% after the breakout. I consider values above 50% to be respectable. Upward breakouts tie the 55% average for all chart pattern types, so that's good. Downward breakouts in bull markets struggle. The average for all chart pattern types is 28%, so wedges fall well short of that value. Table 13.3 shows failure rates for this pattern. I counted how many patterns failed to reach a value, such as 5%. I found that 18% of patterns with upward breakouts and 35% of wedges with downward breakouts failed to see price move more than 5% after the breakout. Half, 51%, couldn't jump a 25% hurdle upward breakouts. Downward breakouts were worse with the hurdle set at 10%, and seeing 55% fail to clear it. As you look down the rows of this table, the failure rates climb to high values quite quickly. Combined with a mediocre, average rise or decline, the pattern's overall performance doesn't bode well for traders using it to make money. Here's how this table is useful. Suppose you have a wedge in a bull market and an upward breakout. The measure rule says to expect a rise of 10 points to the top of the pattern from the current $40 price. That's a 25% rise. According to the table, how many wedges will fail to see price rise more than 25%? Answer: 51%. So half the patterns will fail. It might make you rethink your expectation of a large rise. Table 13.4 shows breakout-related statistics. Breakout direction. Most descending broadening wedges break out upward, as the table shows. Yearly position performance. Mapping performance over where the breakout price appears in the yearly price range, we find that the pattern performs best if the breakout is within a third of the yearly low. In second place is the highest third. You'll want to avoid trading patterns in the middle of the yearly high-low range. They perform worst. Throwbacks and pullbacks. Downward breakouts show a return to the breakout price a bit more frequently than do patterns with upward breakouts. When a throwback or pullback occurs, it takes about 12 days, on average, to complete the return to the breakout price. In other chart pattern types, we see performance suffer when a throwback or pullback happens. I think it's because the curl robs momentum and traders become too shy to trade it after the throwback or pullback completes. For descending wedges, we see downward breakouts exhibit this performance improvement, but not upward breakouts. After a throwback completes, the stock returns to trending upward 77% of the time. Downward breakouts show price resuming their decline 54% of the time. That's about random. Gaps. Common trading lore says a breakout day gap helps performance. With wedges, it's a mixed bag. Gaps help after a downward breakout, but not after an upward one. Notice that the gap size is twice as large after a downward breakout. The size of the gap might be related to downward moves having higher velocity than upward ones, but that's a guess. Table 13.5 shows pattern size statistics. Height. Tall patterns outperform short ones for both breakout directions. In fact, height is the best predictor of future performance. Unfortunately, because we're dealing with probabilities, we can't say for sure if a tall wedge you're considering trading will outperform a short one, but on average, tall ones perform better. To determine if a wedge is tall, compute the height from the highest price at the pattern's start to the lowest one at the pattern's end. Divide the height by the breakout price, the price where the stock closes above or below one of the trend lines. If the result is higher than that shown in the table for the respective breakout direction, then you have a tall pattern. Width. Wide patterns generally perform better than narrow ones, and that's what we see here. I measured the width of each pattern from start to end in calendar days, not price bars, and compared the result to the median width shown in the table. Height and width combinations. Combining the traits of height and width, we find that tall patterns beat the other combinations. If you select a tall pattern, performance doesn't change much if it's wide or narrow, but I'd opt to trade wide patterns anyway. Remember, your pattern might not live up to the average, so pick tall and wide patterns for the best potential performance. Table 13.6 shows volume-related statistics. Volume trend. Does a rising or falling volume trend over the life of the chart pattern suggest better or worse performance after the breakout? Before I answer that, we see that volume trends upward 66% of the time in the descending broadening wedge, rising/falling volume. Performance of wedges is mixed depending on the breakout direction. That inconsistency bothers me. Upward breakouts show better performance if volume was trending down in the pattern. Downward breakouts show the reverse with a rising volume trend within the pattern, from start to end of it, pushing price higher after the breakout. Breakout day volume. Wedges with breakout day volume heavier than the prior month's average show better performance after the breakout. The result matches common trading lore. I left off table 13.7, how often stops hit, because the method to calculate stops doesn't apply to the shape of this pattern. this pattern. Table 13.8 shows the average performance over 3 decades. Performance over time. Upward breakouts show the best performance happened in the 2000s, and downward breakouts performed worse then. That might be because the 2000s had a whopper of a bull market run in technology stocks. Upward breakouts would be pulled along, and downward breakouts would fight a rising tide. The 2 bear markets in the 2000s were excluded from the numbers, failures over time. Upward breakouts show failures climbing from the 1990s to the 2010s. Downward breakouts suffered in the 2010s, with almost half of wedges failing to see price drop more than 5% after the breakout. That's startlingly bad, and I'm a writer who doesn't like using adverbs. Table 13.9 shows busted pattern performance. If you're unfamiliar with busted patterns, consult the glossary busted pattern. Busted patterns count. Downward breakouts bust twice as often as do upward breakouts. Busted occurrence. I sorted busted patterns into 3 types: single, double, and more than twice. Single busted patterns happen most often, which is a blessing because they also perform best. Actually, I didn't measure the individual performance of the other 2, so I'm guessing. Busted and non-busted performance. I wanted to know if a busted pattern performs better than a non-busted one, so I compared them. In other pattern types, the results are closer than I expected except for single busted patterns. They nearly always beat the non-busted pattern performance. We see that trend in this table too for wedges. It's especially true after a downward busted pattern. Single busted patterns soar an average of 65% compared to a rise of just 39% for non-busted patterns. That's a huge difference. There is a catch. The pattern has to single bust and not double or triple plus bust. Unfortunately, I haven't found a way to determine if a pattern will single, double, or triple plus bust. Comparing non-busted patterns to all varieties of busted patterns, single, double, triple plus, we find that busted patterns outperform non-busted ones. Yippee! If you see a descending broadening wedge with a busted downward breakout, then consider trading it after price closes above the top of the pattern. Ride price higher. Trading tactics. Table 13.10 shows trading tactics. Measure rule targets. For upward breakouts, the price target is the top of the pattern. That sounds like it would be easy to reach, and it is for 83% of the patterns. That means 17% never make it up that far before seeing a substantial drop. The bottom portion of the table shows how effective it is to use the pattern's height applied to the breakout price. If you use half the pattern's height added to the top of the pattern, price will reach it 65% of the time after an upward breakout. Subtract the half height from the bottom of the pattern, and just over half of the wedges with downward breakouts will reach the target. Ignore values below 0 and change the decline or rise into a percent so you're not expecting a huge move. Table 13.3 can help you decide if the potential move to the target is realistic. For example, if the target is $5 below the bottom of the wedge with the current price of 30, that's a decline of 5/30 or 17%. Table 13.3 says that 70% of wedges will fail to see price drop more than 15%, the closest value to 17%. In other words, price probably won't make it that far down, but your situation may be different. Partial rises and declines. Figure 13.3 shows an example of a partial decline. Price touches the top trend line, then heads toward the lower trend line, curls around and stages an immediate upward breakout. In bull markets, a partial decline correctly predicts an upward breakout 79% of the time. Partial rises do not work as well. Only 36% correctly predict a downward breakout. I wouldn't rely on partial rises. Busted trade. Downward breakouts that bust outperform their non-busted counterparts, so consider looking for a busted downward breakout. That means waiting for price to bust the downward breakout and going long after the stock closes above the top of the wedge, not the top of the upper trend line. Avoid patterns with nearby overhead resistance. Because this chart pattern has poor performance, Trade only when the stock, industry, and market are trending upward. That way, you are more likely to find a single busted pattern, and those blow the doors off performance. Not sure what that means, but it sounds way cool. Experience. Let me tell you about what I found in my trade review. DR, Horton Inc. Some trades get away from you like the one in DR, Horton Inc. DHI. In December 2006, the stock made a descending broadening wedge. It was small but tight, with lots of trend line touches and with the stock bouncing from top to bottom, just like you'd expect to see in a well-formed wedge. I made the perfect entry, buying into the stock 2 days after the breakout. I could have bought a day sooner and received a better fill, but I snagged the opening price of 27.32 and was happy about that. From my trading notebook, 18 January 2007. This CO's stock is doing twice as well as KBH, KB Home, and I'm flush with cash. It broke out upward from a descending broadening wedge, so call that the buy signal. For a time, the stock cooperated. It did a measured move-up type stair-step rise and peaked at 31.13, a gain of 14% above my buy price. Then the tide left the station, to mix metaphors. Price made a measured move down, stair-step pattern, mirroring the upward move except sinking. The pause in the middle of the pattern was right where it paused on the way up, showing a very pretty mirror of the left side. The stock continued a near straight line run down to 22.02 for a potential loss of 19%. In mid-March, I wrote this in my notebook. This has completed a downward move from what I can see. The sharp up move starting 10 November 2006 has been reversed. Review of stock charts says that when a decline, not necessarily a quick one, follows a quick rise, price begins rising again, recovering the loss and then some. This looks to me to have completed the reversal, even though the fundamentals suggest a bumpy road ahead. Buried in my notes was the trap. Did you find it? Price begins rising again, recovering the loss and then some. I did my research and concluded the stock would rise. All I had to do was wait and I'd be rewarded. The stock moved sideways for 3 months. No big deal. I don't mind waiting for my trades to work. The stock dropped again in another straight line run down. Oh, I threw in the towel on 27 June 2007. From my notebook, sell reason, this looks like it's about to fall off a cliff and it dropped below a double bottom low from April. Price will continue down, so I'm selling. The double bottom in April looks more like a head and shoulders bottom that started in March. I lost 26% on the trade. Yes, you can laugh now. Wait until it happens to you. Did the stock fall off a cliff? Yes, it did. It dropped to 10.15, a decline of 49% below the 20 where I sold. Lesson: plan the trade and trade the plan. Plan? What plan? I didn't flush out this trade before I entered it. For a few weeks, it looked as if the trade might work out well. But then the trend reversed. It appears this was a buy and hold mistake, not a planned swing or position trade, so I was willing to give the stock room to grow or shrink in this case. Even after the stock dropped back to 22, it looked like that would be the end of the decline because it was resting on support. Indeed, the stock moved sideways for 3 months. When the stock fell through the ice supporting it, I sold. Perfect entry, but a very late exit. Texas Industries. I don't know if it was too soon to realize we had entered a bear market on 3 August 2000, which started on 24 March 2000. But sometimes stocks like to go their own way. Texas Industries, TXI, formed a large and loose-looking descending wedge. The day after it broke out upward, I was there with a fist full of bucks. I bought, so it was the perfect entry. From my notebook, reasons for purchase, it has made an upside breakout, on weak volume, from a descending broadening formation. The Federal Reserve, is going to impose anti-dumping penalties as high as 95.29% on imports of certain types of coated steel sheet. This may help the CO. After reviewing stats in Encyclopedia book for broadening wedge, descending, it looked like a good trade. Upside is 36, downside is 30, evenly split from 33. I think this will continue moving higher, maybe to the old high at 43.3/8. I received a fill at 33.06. The stock eased a bit lower as if it were making a flag pattern. The drift down wasn't much, but it lasted over a week. Then the stock took off. In 3 days, it was just 6 cents below 35, and then the stock dropped like a stone all the way down to 20.88, a decline of 40%, bottoming in November. Fortunately, I pulled a rabbit out of my hat, and on 23 August, I sold the stock for a profit. From my notebook, I sold around 33.9/16. I think the stock is heading down as it is following the others moving down. All are off their peaks by 1/1/2 to 2/1/2 points, and I don't see a turnaround. I made 1% on the trade on a position about half the normal size. Lesson: I'm not sure there is one. I made a perfect entry but a late exit. The stock rounded over at the peak and then started heading lower with gusto. I sold quickly for a profit and avoided taking a 40% loss. Sample trade. Do you feel lucky, punk? Mary asks as she looks at her computer screen, figure 13.5. She just finished watching a Dirty Harry movie and is feeling ornery. She decides to buy the stock when price rebounds off the lower trend line. When it is clear the stock is climbing again, she pulls the trigger and receives a fill at 43. Immediately, she places a stop-loss order 15 cents below the lower trend line at a price of 42. If things go wrong, she only will lose 3%. Then she waits. The stock cooperates by moving higher each day. Soon it is at the top trend line, and she waits for it to ricochet off the line and begin heading down. It doesn't. Instead, price closes above the top trend line, signaling an upward breakout. She calculates the price target, 49.63, using the formation height added to the breakout price, and that is where she places her sell order. I'm hoping the target is a minimum price move, but it seems a long way away. It might be a maximum. She raises her stop-loss point to 44, slightly below the minor low in mid-April. As the stock advances each day, she keeps wondering why it has not paused. She shrugs and does not worry about it. When the stock makes a new high at 47.38, she raises her stop to 45.25, slightly below the 2 minor highs in late April and mid-May. In a burst of energy, the stock zooms up over a 2-day period and reaches her sell target. The stock sells at the high for the day, 49.63. She has cleared over $6 a share on her trade. Even better, the stock moves lower for several days, reinforcing her sell decision as being the correct one. She sold too soon, but she doesn't care. She spots another promising pattern in a stock she has been following for quite some time. She leans back in her chair, smiles and mumbles something about luck, then runs to the DVD player and plugs in another Dirty Harry movie. I talked to her about the trade. On the entry, the stock could have continued lower, she told me, but happened to turn upward at the bottom trend line. It was a risky entry. Balancing that was a well-formed wedge. The wedge had several trend line touches and looked long enough to be ready to break out upward. I entered just as the stock made a straight line run higher. It could have paused along the way and dropped far enough to hit my stop, especially when the stock moved to the top of the wedge. For a swing trade, I've found that setting a sell order at the price target, like she did, can get you out of the trade right at or near the high. The stock may continue to trend higher as in this case, but you may be surprised how often the sell order works better than other exit methods. End of Chapter 13. Chapter 14. Bump and Run Reversal Bottom. Results Snapshot. Appearance. Looks like a frying pan with the handle on the left following a trend line down until a large decline ensues. The right side of the pan sees price recover and break out upward. More than a year after I discovered the bump and run reversal bar top, I decided to look for its complement, the bar bottom. The reason was simple. Many chart patterns, such as double tops, ascending triangles, and triple tops, have bottom versions. Why not the bump and run reversal? It never dawned on me to look for the pattern before then. As I searched through the data looking for candidates, I was skeptical that the pattern added real value. Some looked like cup with handles with the handle coming first, whereas others looked like rounding bottoms. Only after I compiled the statistics did my thoughts change. The pattern is a strong performer with gains averaging between 35% and 55%, placing the first and second in the performance rank for bull and bear markets. The break-even failure rate is small too, coming in at 10% or less. Grab your magnifying glass and let's look closer at this pattern. Tour. What is a bump and run reversal anyway? If I had to name this formation independent of all others, I would probably call it the frying pan or spoon because that is what it looks like. However, the formation is just a bar top flipped upside down, so I call it a bar bottom. I guess a more accurate description is an inverted bar. Why do bar bottoms occur? Like the top version, the bar bottom is a study of momentum. Consider the chart shown in Figure 14.1 on the weekly scale. The last week of October 1993 initiated a long climb to the highs of early January 1994. On the highest volume that the stock had seen in years, the stock hit a new high of 14.38 during the week of 14 January. Volume began tapering off, although it was still high, and price tagged a much smaller peak during the week of 25 March at 14. The two minor highs, one in mid-January and another in late March, formed the basis of a down-sloping trend line. As weekly volume trended lower, so did enthusiasm for the stock. Eventually, bullish sentiment could not sustain the high price and the stock collapsed. As it headed down, volume continued to taper off. The upward momentum experienced during the rise to the highs in January was now working against the stock. Over the course of a year, the stock gave back all of its gains, and by mid-February 1995, it started sinking to new lows. High volume a month later was important because it signaled a turning point. A week later, again on high volume, the stock closed higher by over 10%. The upward move had begun but soon stalled out. The stock moved sideways for another 2 months, gathering strength for the uphill run. Then it took off, not jumping up but slowly moving higher, almost week after week. When the stock reached the trendline in mid-August 1995, it was clear that it had executed a massive rounding bottom, a turn in the trend that signaled higher price. The stock pushed through the trendline on relatively high volume, then paused for a month and formed a falling wedge or pennant. Following that, on very high volume, price jumped up to new highs, but this did not last very long as the stock entered a consolidation phase below 18. There it stayed for many months before the stock jumped up and ran still higher. By late June 1996, the stock had touched 28.75, a rise of about 140% from the breakout and 350% from the low. Many might think this formation is a cup with handle, but it's too long, at 1 year and 9 months. It's a bar bottom because a cup does not depend on a down-sloping trend line and a larger handle on the left such as that shown in the figure. Whatever you call the chart pattern, the result is still the same: price moved higher. Identification guidelines. Table 14.1 shows a host of characteristics that correctly identify a bar bottom. Figure 14.2 illustrates the various characteristics outlined in the table. Appearance. Overall, the chart pattern appears as a frying pan. The handle, or lead in phase, forms a trend line that slopes downward at an angle of about 30 degrees to 45 degrees, more or less. Draw the trend line along the high price because the line signals a buying opportunity once pierced. Unlike bar tops, sometimes horizontal trend lines in the lead in phase contain valid bar bottoms. Such situations are rare, though, and should be avoided. The trend lines in this study are higher on the left and slope downward. These give the best performance. Arithmetic scale. Use the arithmetic scale, not a semi-logarithmic one, because the semi-log scale distorts vertical distances. Down-sloping top trend line, lead in height. Calculate the lead in height once a trend line forms. Do this by finding the widest distance from the trend line to the daily low, measured vertically in the first quarter of the bar. In Figure 14.2, the lead in height calculation uses price on 16 June point A. On that day, the low is 17.63 and the trend line has a value of about 20.38. Thus, the lead in height is the difference between these two, or 2.75. The minimum bump height uses the lead in height, so the calculation is important. Bump phase. After the lead in phase comes the bump phase. Price declines rapidly, although usually not as rapidly as that shown in Figure 14.2, and forms a new trend line that slopes down at about 45 degrees to 60 degrees or more. Volume is noticeably higher at the start of the bump, but selling pressure overtakes buying demand, and the truth finally comes out: there are problems with the company. The stock continues down as the smart money and the momentum players leave the stock in droves. Eventually, downward selling pressure abates, allowing the stock to recover. It rounds up and touches the original 30-degree trendline. Here, it may move lower for a while, or it may sail right through the trendline. Over half of the time, price starts moving higher, then throws back to the trendline before continuing up. Dual bumps. Price touches the trendline on its way to the breakout, but instead of continuing higher, it declines and forms a second bump. A second bump will appear 12% of the time in bull markets and 11% of the time in bear markets. Oddly, patterns with dual bumps perform better. I'll mention that in statistics coming later. Uphill run, volume. Volume picks up as price breaks out of the bar and price moves higher. Rising price characterizes the uphill run phase. Breakout direction, confirmation. Bar bottoms always break out upward. If your pattern sees price close below the bottom of the pattern before closing above the down-sloping trend line, then it's not a valid pattern. Focus on failures. Figure 14.3 shows what a bar bottom failure looks like. Price reaches a new high for the year, the highest peak on the left. Then it is downhill from there. The decline is quite orderly with peaks that follow the trend line down. During early September, however, price drops rapidly on high volume as the bump forms. Price quickly reaches a low of 33.63 before rebounding. Having sliced through the trend line and moving just a bit higher, price throws back and follows the trend line lower. Price following a trend line lower is not unusual, but what is unusual is that price does not continue its climb. Instead, it drops off the end of the trend line and plummets. By late June, the stock slips under $20 a share, less than half what it was at the high. Why did the bar fail? This formation is not a perfect example of a bar bottom, but few patterns are. In this case, the bump height is less than twice the lead in height. However, the height depends on how the trend line is drawn. Starting the pattern, drawing the trend line from the peak at point A, the bump to lead in height is about 2-to-1. The new trend line would also touch the peak at B. So, if you wait for price to move above the new trend line before investing, you would not purchase this stock. Sometimes it is wise to draw alternative views just to see how the chart pattern behaves. In the example as I have drawn it, the stock fails because price does not rise more than 5% after the breakout. It's what I call a 5% failure. Statistics. Table 14.2 shows general statistics. Number found. I found 1381 patterns in 642 stocks from July 1991 to July 2018. Not all stocks covered the entire time, and some no longer trade. Reversal R, continuation C occurrence. The pattern acts as a reversal most often, but the numbers are close in bull markets, but much farther apart in bear markets. Reversal/continuation performance. Patterns acting as continuations outperform those acting as reversals. Average rise. The average rise is a strong 55% in bull markets and 35% in bear markets, handily beating the average rise of 42% and 28%, respectively, of other chart pattern types. Dual bump average rise. I checked to see if patterns with dual bumps worked better than their non-bump counterparts. In bull markets, patterns with dual bumps saw price climb 61% versus 54% for those with only one bump. In bear markets, dual bump patterns saw price climb an average of 43% versus 34% for the non-dual bump variety. Standard and Poor's 500 change. The index did well, but it surprises me that it was positive in bear markets. Keep in mind that the measurement periods use dates of the bar's breakout to ultimate high. Apparently, the index averaged a small gain during those periods in bear markets, days to ultimate high. To reach a gain of 55% in bull markets, it took almost a year. If the rise in bear markets happened at the same speed, it would take the average bar pattern 207 days to climb 35%. In reality, it took just 124 days. That's not quite twice as fast, but it's close. Even though price is moving higher in both markets, bear markets show higher velocity than bull markets. This finding isn't related to bars. I've seen it in other chart patterns too. How many change trend? Here's where the pattern really shines. I consider values above 50% to be terrific. This pattern sees more than half of the patterns see price climb more than 20%, which is what's meant by a trend change after the breakout. Failure rates appear in Table 14.3, and they show good results. Few patterns flame out before climbing more than 5%. In bull markets 9% fail, and in bear markets 10% fail. That's low compared to many other chart patterns. Look at what happens at the 10% rate, which asks how many patterns fail to see price rise more than 10% after an upward breakout. The numbers doubled from the prior row. 9% becomes 18%, and 10% becomes 23%. How do you use this table? Let me give you an example. Say your cost of trading is 5% and you want to make a 30% profit for a total of 35%. How many patterns will fail to rise more than 35%? Answer: 49% in bull markets and 68% in bear markets. Between half and 2/3 of the trades you make will fail to meet your goal. That means your winners will have to perform dramatically better to compensate for all the losers you should expect to have. That's if you trade the pattern perfectly and hundreds of times too. You may trade the pattern better or worse. Table 14.4 shows breakout-related statistics. Breakout direction. By definition, the breakout is always upward. If you have a bar bottom with a downward breakout, then it's not a bar bottom. It's a mistake. Yearly position performance. Mapping performance over the yearly price range, we find that the best performing bars are those with breakouts near the yearly high. Those are the ones in which you want to trade. The closer the breakout price is to the yearly low, the worse the performance. This finding suggests bar bottoms make for delicious momentum trades. Avoid bottom fishing bars. Throwbacks. Over half the patterns throw back. The stocks trend upward for about a week before returning to the breakout price in a round-trip time of 11 to 13 days. As with many other chart pattern types, throwbacks hurts performance. After a throwback completes, the stock resumes the upward trend a good portion of the time, more than 77% of the time. Gaps. Gaps help performance in both bull and bear markets. The performance difference is not high, so don't lose any sleep over it. However, because I use the opening price the day after the gap in the measure to the ultimate high, you don't need to own the stock before the gap to participate in the better performance. Number of dual bumps. A second bump occurs about 11% to 12% of the time according to a study I conducted. Figure 14.4 shows a good example of a multiple bump bar. The first bump completes in mid-August 1993 when price touches the down-sloping trend line. If you purchased the stock at any time during creation of the first bump, you would have been toast. From the high of 22.75 on 19 August, the stock declined to 17.38 on 1 October, nearly a 25% drop. After that, it was all uphill. The stock moved up smartly and crested at 28.50 in mid-January 1994. From the bump low, that was a 64% move and a 33% rise from the breakout. The figure imparts a valuable lesson. Consider waiting for the upward breakout before buying into a bar. Not surprisingly, this lesson applies to many chart pattern types, not just the bar bottom. The dual bump is unusual in that the second bump bottoms lower than the first. As mentioned, dual bumps are rare. Of course, that is scant comfort if you already bought into a situation and price begins declining again during the second bump. Table 14.5 shows size statistics for the bar bottom pattern. Height. Tall patterns perform better than short ones. To use this information, measure your pattern from the highest high to the lowest low and divide by the breakout price, where price closes above the down-sloping trend line. Compare the result with the median in the table. If your value is higher than the median, then consider your pattern tall. Lower than the median means it's short. Trade tall patterns for the best performance. However, also note that the performance difference between short and tall isn't great, 3 percentage points. So if the computation is too difficult for your fingers to handle and you don't want to use your toes, then ignore it. The stock will perform however it wants. Your challenge will be to get as much money out of the trade as possible. Width. Wide patterns perform better than narrow ones, but only in bear markets. I used the median width as the separator between narrow and wide, height and width combinations. In bear markets, patterns both tall and wide should outperform, but they place second. Short and wide wins. In both bull and bear markets, the worst performance comes from patterns that are short and narrow, so avoid trading those. Table 14.6 shows volume-related statistics. Volume trend. Volume trends upward about 2/3 of the time. Rising/falling volume. If volume recedes over the length of the bar bottom, performance improves. I used linear regression to find the slope of the volume trend, but sometimes you can tell by using your eyes. Split the pattern in half and determine which half has higher volume. Breakout day volume. Heavy breakout volume only helps in bear markets. Because of the way I measure stop-loss locations, Table 14.7, how often stops hit, does not apply. You can look for it, but you won't find it hidden in this chapter. Table 14.8 shows the performance of bars over 3 decades. I only show bull market statistics because both bear markets occurred in the 2000s. Performance over time. Performance has improved over the years. Cool beans. Failures over time. Recently, the failure rate has turned steady at about 7%. Failures are a count of how many bars see price fail to rise more than 5% after the breakout. Table 14.9 shows busted pattern performance. Busted patterns count. Comparatively, few patterns bust because price after the breakout tends to keep going up. Busted occurrence. I counted the types of busts: single, double, or 3 or more triple plus. Single busts happen most often, followed by double and triple busts, in that order. This may sound odd, but sometimes triple plus busts happen more often than double busts. Busted and non-busted performance. I don't have a non-busted bar bottom with a downward breakout to compare to single and all busted types. Single busted patterns outperform the combination of all 3 types of busts, including single busts. Trading tactics. Table 14.10 outlines trading tactics for bar bottoms. Measure rule. After properly identifying a bar bottom, you will want to determine how profitable a trade is likely to be. You do that using the measure rule, but it's really a guideline, and it only tells how often price will climb to an arbitrary price. The highest high is the measure rule target, and price reaches the high 64% to 76% of the time. The lower portion of the table shows this pattern top. The remainder of the table shows how often price reaches a multiple of the height, from 0.5 to 3 times the pattern's height. For example, in bull markets, price will reach the full height target, the pattern's height added to the top of the pattern, 46% of the time. Notice that I use the top of the pattern and not the breakout price in the computation. As a sanity check, compute the rise to the target from the current price. Let's say it's $10 in a stock trading at 60. The height represents a 17% rise, 10/60. Table 14.3 says that 25% of bar bottoms will fail to see price rise at least 15%, the closes to 17% in bull markets. That leaves 75% as winners, which is reasonable. Wait for confirmation. Confirmation happens when price closes above the trendline formed during the lead-in phase. Should the price close above the trendline, buy the stock. Waiting for an upward breakout prevents a loss should the stock break out downward or form a second bump. Sell at old high. Place a sell order near the price level of the old high, the price at the start of the bar. That will keep your profits intact should the stock then turn down. If you are reluctant to sell your holdings, why not sell half when the stock reaches the old high, and then see what happens? Figure 14.5 shows an example of the situation I'm writing about. Price began the bar at 32.88 and then formed a descending triangle. It's not a good triangle because it only has 4 trendline touches instead of 5 and too much white space. Where the bottom trendline cuts through price at the gap, at pattern start, doesn't count because it's not a minor low. In June, parts began falling off the semiconductor stock. The breakaway gap saw price plummet over $4 to close at 23.75 on 7 June, then continue lower, reaching a low in June in the middle of the bump phase. From the low, price recovered and moved higher until reaching a high just 25 cents below the price at the start of the bar pattern. Then the stock faded. A sale at the old high would have been timely in this example. Experience. As well-performing as this pattern is, I have only traded it once, mostly because it has so many rules that it's hard to find. I don't just see the pattern during the stock scans, I have to hunt for it. Figure 14.6 shows the damage. The bar took shape in April 2018 with the lead-in portion of the pattern A. The stock formed the bump, B, dropped, and completed the rounded turn. Price climbed up to the trend line and backed off, creating a second bump, see a dual bump bar. When the stock closed above the trend line, I bought at the open the next day, but a position that was about 2/3 the normal size, which is typical. If the trade does well, I'll buy more to fill out the position. There were lots of warning signs in my notebook entry for the trade. 7 July 2018, huge insider selling, lots of people, but for small amounts as high as 20K shares, but most about 3-4K. S&P says strong buy as of 11 May 2018, medium risk. Credit Suisse says outperform but no report available. All analysts are positive on this. Ford says hold though. This trade was meant as a long-term holding, with resistance at 82 and 85 and support at 75.77. A stop-loss order was set for 77 or 4.4% below the buy price, but as a long-term holding, I didn't place it. I did note that weekly scale, stair-step rise, Elliott wave, stage 5. Yikes, danger, danger, Will Robinson, have I dated myself? The industry was moving lower with 6 stocks up and 11 down compared to 16/1 up/down over the prior 2 months and 11/6 over the prior 6 months. My computer screamed at me, warning, the industry is trending downward. You're about to lose money. Did I listen? Buy reason, bar up bout. That says it all, in an industry that's doing well. 9 of 59 relative strength compared to other industries where one is the best performing. Fast forward to 17 April 2019. Sell reason, this just looks like it might return to the deck 2018 launch price. It's not been a good performer for me, so I'm dumping the dog. Wells Fargo downgraded the stock today, 15th, I think. I sold on weakness. The launch price I'm referring to was the drop to F. That's where the stock started its climb to the double top in February and April, H&H. I didn't want to see the stock return to the price at F, so I sold it at E. In fact, the stock did drop to the launch price and dropped a bit below it, to G. As bad as the chart looks, I only lost 10%. About a week after I sold I, the company announced earnings that the market hated. The stock dropped and gapped exhaustion gap even lower the next day. The entry to this trade was perfect. The exit was late. Between the two, the stock made a substantial decline before partially recovering. If I had a rule that said sell if a buy and hold position drops 20%, then my loss would have been double what it was. However, there is a clue to what I did wrong, and it appears at J. Price gapped lower, breakaway gap after the announcement of earnings. Often with buy and hold positions, you're looking to hold for years, so I ignore earnings results. However, earnings came about a month after I bought and the market didn't like it. That announcement set up a price cascade that saw the stock drop from the high by 29% to the low at F. Often I'll sell after poor earnings in my swing trades, but apparently chose to ignore it in this buy and hold. Lesson: sell quickly if the market doesn't like an earnings announcement. Otherwise, it could be months or longer for price to recover. Sample trade. Perhaps the most interesting way to illustrate trading tactics is by example. John is new to investing, and he did not take the time to learn thoroughly about bar bottoms. As he flipped through his stock charts one day, he noticed an intriguing situation developing in the stock depicted in figure 14.7. During August, the stock peaked, declined a bit, and then formed a second minor high. As the stock declined from the second high, John drew a trend line down connecting them. Soon, he noticed that the stock was descending in a sort of channel. He drew a second trend line, parallel to the first that connected the lows. However, the stock soon pierced through the second trend line and moved lower. I thought I recognized a bar bottom forming, so I drew a third trend line, parallel to the other two and lead in height apart. When the stock dipped below the lowest trend line, I thought the decline was over. So the next day, I bought 100 shares at 18.25. I was tickled to buy the stock a bit below the closing price for the day. For the next week, the stock shot upward and pierced the middle trend line. John called me up. "Trading stocks is an easy game," he said. "I can't lose." The stock began consolidating, but he showed no concern. Flat periods of trading often follow quick rises. When the stock neared the top trend line, John calculated the target price, using the old method, using the pattern's height, instead of the target being the highest high in the pattern. He computed the lead in height by subtracting the daily low from the trend line at its tallest part in the first quarter of the pattern. He used the low of 20 August at 24 and subtracted this from the trendline value of 26, measured vertically. This left him with a lead in height of $2. John thought that the stock would likely break out at about 21.25, so this gave him a target price of 23.25, which is the lead in height added to the breakout price, and not the top of the pattern. If this works as I expect it to, I'll make more than 25%. Isn't that terrific? For about a month, the stock moved sideways, but this did not alarm him. He even expected the stock to decline a bit and recapture some of its quick gains. But he was growing impatient. "When is this going to break out upward?" he asked. "It's stuck in a trading range. I know it's going up, but I want it to go higher, not tomorrow, not next week, but now." After the stock approached the top trend line and went horizontal, it started dropping in November. It touched the middle trend line. These things retrace between 38% and 62%. He grabbed his calculator and computed the retrace value. The stock reached a high of 21.43 in a straight line run from the low at 18, a rise of about 3.50 points. Now the stock was retracing the gains and had moved down to 18.75 for a 78% retrace. Clearly, this was out of the realm of a simple retrace. Should I be worried? I think the trend has changed, but I expect the stock to touch the middle trend line and start recovering. The stock paused for 3 days at the middle trend line before moving lower again. It quickly fell below his buy price and headed down. "I know this was supposed to be a short-term trade, but I'm holding on to this for the long term. As soon as I get my money back, I'll sell." The stock moved below the bottom trend line. The easy game was now turning into a disaster. "I thought about selling right there." He pointed at 11 December when the stock reached 12.75 for a 30% loss. "But this trade is a long-term holding. I should expect some weakness." The next day, the stock closed higher, and it gave him renewed hope. Indeed, it closed even higher the following day, but the 2-day recovery was an illusion and the stock declined again. As it plunged below 12.75, John threw up his hands and told his broker to dump the dog. He received a fill at 12.25, the low for the day. From the buy price, John lost 35%. 2 days later, the stock bottomed at about 10.75. As upset as this made John, the stock was not finished tormenting him. He continued to follow it and watched it recover. He extended the bar trend line downward, figure 14.8, weekly scale, and noticed that a new, larger bar had formed. After suffering through the large bump in December, the stock moved higher until it touched the bar trend line. Then, the stock slid along the trend line, following it lower, unable to pierce the resistance. During the week of 27 March 1992, the stock closed above the trend line for the first time in months. The bar was complete, and a confirmed breakout was occurring. Did John buy the stock? No. For several months, he watched its progress as it moved higher almost week after week. Disgusted, he quit following the stock. In April 1994, John took another look at the stock and was surprised to see that it continued moving higher. It had just reached a high of 50.13, a climb of almost 370%. He grabbed his calculator and realized that his mistake cost him over $3,000. "What did you do wrong?" I asked him. "Several things. I didn't wait for the bar to pierce the top trend line and move higher. If I had, I would have bought closer to the low, saving lots of money. The big mistake was not cutting my losses short. After I bought, I should have determined my stop price. When price climbed above the middle trend line, below that support would have been a good place for a stop-loss order. In this case, it would have taken him out of the stock at about 17.88, a small decline from the purchase price of 18.25. Instead, I followed the stock down and changed my investment philosophy from a short-term trade to a long-term holding. End of Chapter 14. Chapter 15, Bump and Run Reversal, Top. Results Snapshot. Appearance, price rises steadily along a trend line, bumps up, rounds over, and then declines through the trend line and continues down. If you were thinking of buying stock in a company, wouldn't it be wonderful if you knew the purchase price would be less tomorrow? Of course, but how do you predict tomorrow's price? That is the problem I was researching when I discovered the bump and run reversal top. I was trying to figure out a reliable way to determine if tomorrow's price would be higher or lower than today's, and by how much. I tried all sorts of mathematical games to boost the accuracy of the prediction with only limited success. Then I moved to the visual world. I drew a trend line along a stock chart and wondered if I could determine how far price would decline below the line. I looked at many stock charts and trend lines trying to see if there was a relationship between a trend line and the breakdown of the trend. That is when I discovered it, the bump and run formation, BARF for short. I toyed with the idea of leaving the name as is, but decided that the investment community wouldn't believe the veracity of the new pattern. So, I changed the name to Bump and Run Reversal BAR, a slightly more descriptive and palatable acronym. The above results snapshot shows that the pattern ranks third for performance in both bull and bear markets where a rank of 1 is best. That means the average decline is better than average. That sentence reminds me of the Department of Redundancy Department. One quick note, the percentage meeting price target is based on the stock dropping to the low posted at the start of the bar, not on the pattern's height. Let's take a tour of the pattern. Tour, figure 15.1 shows a good bar example. The overall pattern reminds me of a mountain range. The foothills at the start of the pattern are low and subdued, not venturing too far above the up-sloping plane. Volume at the start of the pattern is high but recedes quickly. The mountains rise well above the foothills on high volume. Investor enthusiasm continues as price rounds over at the top, then diminishes on the far side. When the mountains end, price declines sharply and continues down. That is a bar pattern. Price bumps up, rounds over, and runs back down. The chart pattern is the visual representation of momentum. The base of the pattern follows a trend line that always slopes upward. It signals investors' eagerness to acquire the stock. As each day goes by, investors bid higher to reluctant sellers, and the price rises. Other momentum players eventually notice the rise in the stock's price. Many jump on the bandwagon the day after a surprisingly good earnings announcement. That's when the bump begins. Volume spikes upward along with the stock's price. Quickly rising prices entice others to join the fray, and that in turn sends the stock even higher. As momentum increases, price jumps to form a new, higher sloping trend line. Then things start going wrong. Supply catches demand. As that happens, the rise slows and the smart money turns cautious. Investor enthusiasm wanes and the war between supply and demand turns. The stock rounds over and starts heading down. When the smart money sees price falling, they sell, and the decline picks up speed. Downward momentum increases and returns price to the trend line. At this point, buying enthusiasm may increase and send price back up for one last try at a new peak. Usually, however, price does not bounce off the trend line but continues down. Sometimes there is a pause, and sometimes price just plunges straight through the resistance line, as illustrated in figure 15.1. Once price pierces the trend line, volume increases as investors dump the stock. This selling alarms more investors, and the downward trend feeds on itself. Eventually, after several months of declining price, the selling pressure abates and buying enthusiasm halts the downward slide. Price tentatively levels out and perhaps even rebounds some. Once the cause of the reversal fades from memory, price starts rising again and the process begins anew. Identification guidelines. Table 15.1 outlines the various parts of the bar that are illustrated in figure 15.1. Appearance. Look for price to rise at the start of the pattern, but the high-low range is short compared to the bump phase. Price rises following a trend line. During the bump phase, price forms a tall mountain. After that, the stock heads down and continues dropping, plunging through the trendline setup during the start of the chart pattern. Arithmetic scale. Use the arithmetic scale, not a semi-logarithmic one, because the semi-log scale distorts vertical distance. Rising trend lines. In the figure, an up-sloping trend line drawn below the lows in the stock extends until it intersects price as it declines in May. Volume is high at the start of the pattern and the price trend is up. That is a key consideration. Price must be rising. The trend line should be approximately 30 degrees, but the degree of slope depends on the scaling used to view the chart. If the trend line is flat, or nearly so, it is not a good bar candidate. A rising trend line shows investor enthusiasm for the stock. However, the trend line should not be too steep either. Steep trend lines over 60 degrees or so do not allow enough room for the bump to complete properly. Lead in phase, lead in height. The first part of the pattern, called the lead in phase, leads to the bump phase. The lead in phase should be at least 1 month long but be flexible and usually falls in the 2 to 3 month range but can be considerably longer. Price oscillates up and down in this phase and has a range of at least $1 as measured from the highest high to the trend line, but this will vary with the price of the stock. This range, called the lead in height, is calculated using price from the first quarter of the entire chart pattern. Figure 15.1, for example, shows that the highest high during the first quarter of the pattern occurs on 12 January 1994 at 25.63. The trend line directly below this date has a value of about 24.25, giving a lead in height of 1.38. The height is important because the minimum bump height and target price, calculated later, use this value. A more accurate approach is to use the tallest distance from the trend line to the high, which is not necessarily found between the highest high and the trend line. Use whatever method makes you feel comfortable. During the lead-in phase, subdued price action looks as if the stock is gathering strength for the bump phase. Price does not move very far away from the trend line and usually appears rounded. If you visualize the chart pattern as a mountain range, the lead-in phase represents the foothills. Volume during the lead-in phase is high at the start. Often this is due to events that occur just before the bar begins. Volume drops off until the start of the bump, when it suddenly rises. The higher share turnover and buying enthusiasm for the stock forces price up. In Figure 15.1, this price rise occurs on 17 February and is accompanied by volume that is the highest in half a year. Rounded bump. Price jumps up at the bump start and quickly rises from a low of 26.50 to a high of 34.38 during late March. Volume remains high throughout this period, then quickly tapers off as price rounds over at the top. Many times, the top takes on the appearance of a head and shoulders pattern or a double or triple top. If you recognize any of these patterns on your chart, ignore the bar top formation and obey the implications of the individual patterns. The bump height, as measured from the highest high to the trend line, should be at least twice the lead in height. In this example, the bump height is 8, that is, 34.38, 26.38. This is more than twice the lead in height of 1.38. The reason for the minimum 2-to-1 ratio is arbitrary. The idea is to make sure that investor enthusiasm and hence momentum are getting carried away. An up-sloping trend line that turns into a bump with a higher sloping trend line emphasizes the rising momentum. Sustaining such unbounded enthusiasm for too long is difficult, and the stock eventually declines. In Figure 15.1, a decline is exactly what happens. Price rounds over and starts heading down. Sometimes the decline is orderly and sometimes it is choppy. In nearly all cases, price returns to the trend line. Once there, the stock may do several things. Dual bumps. Fairly often price bumps up again, and that is called a bar with a dual bump or a dual bar. Occasionally, a dual bar consists of several bumps, but the result is still the same. Price eventually falls below the trend line. Downhill run. Sometimes price slides up along the trend line for a month or so before continuing down. At other times, price drops straight through the trend line, turns around and climbs again before ultimately dropping. In a few rare cases, price descends from the bump high and never makes it back to the trend line before moving higher. These cases commonly appear on weekly or monthly price charts. If price fails to close below the trend line, then the bar pattern is invalid. Breakout direction, confirmation. The breakout from this pattern is downward by definition. If price doesn't break out downward, then it isn't a valid bar top. Focus on failures. In the weekly chart shown in Figure 15.2, the first bar on the left shows high volume during the initial stages of the bump, as you would expect. The bump height to lead in height ratio looks good over 21, and clearly investor enthusiasm is high. However, price continues climbing instead of rounding over and heading down. The pattern is not a valid bar. Contrast the failed bar with the one in the center. The middle bar has a nicely rounded appearance. The volume pattern is what you would expect, high at the start of the bump, and when price crosses the trend line. However, price drops below the trend line by just 4%. Any stock recovering after dropping no more than 5% below the breakout price is called a 5% failure. The bar on the right is a dual bar. Price nears the trend line in late March 1994, but remains above it in this case, so it's a flawed example of a dual bar, and then just as quickly climbs again, forming a second peak before dropping through the trend line. Often the peak of the second bump is below the first. On weekly and monthly price charts, you will often see price moving up steadily over time. However, without the sharp bump up of price, the rising trend should not be labeled a bar. The slope of the price trend line should rise from about 30 degrees at the start to 60 degrees or higher during the bump phase. Your chart's aspect ratio may make determining the degree of slope more difficult. To reduce the failure rate, wait for price to close below the trend line. Waiting boosts the success rate, but reduces the profit that you would make if you sold near the top. In the trading tactics section of this chapter, I'll show you how to sell near the top before the decline really begins. That way you can keep more of your profit or make even more by shorting. Statistics. Table 15.2 shows general statistics for bar tops. Number found. Bar tops are plentiful. I found the first one in July 1991 and finished my search in August 2019. During that time, I found 1766 in 758 stocks. Reversal R, continuation C occurrence. Most of the patterns acted as reversals of the prevailing price trend, not as continuations. Because we know the breakout will be downward from a valid bar top, the inbound price trend for a reversal must be below the pattern. Reversal/continuation performance. There's not a big performance difference between reversals and continuations as the table shows. Average decline. As you would expect, the average decline in bull markets, 17%, is less than the superb results in bear markets, 24%. Both are better than the average decline for all chart pattern types, which is why the pattern has a good performance rank. Standard & Poor's 500 change. In bull markets, the S&P 500 index dropped 1%. I expected to see a rise, so I checked the statistics and they are correct. However, bar tops are a bearish chart pattern. Perhaps price drops along with a falling general market, even though the market trend remains bullish bull markets. The index in bear markets, with declines averaging 12%, helps pull the stocks showing bar tops lower after downward breakouts. Days to ultimate low. It takes about 2 months to reach the ultimate low. Notice, however, that the 24% drop in bear markets takes 54 days, but a 17% drop in bull markets takes 67 days. The bear market decline has a higher velocity, but by how much? Answer: the bear market drop is almost twice as fast as the one in bull markets. How many change trend? It's rare that bearish chart patterns see price drop more than 20%. I consider values above 50% to be good, but that's for upward breakouts. Even so, the bear market with more than half of the patterns showing declines above 20% speaks to an especially precarious situation. If you see a bar top in a bear market and have the skills to manage a short sale, then consider shorting the stock after a downward breakout. You can make a lot of money quickly if you trade it properly. Table 15.3 lists failure rates for bar tops. Failures start small compared to other chart pattern types, especially in bear markets. As one might expect, the failure rates in bear markets are smaller than those in bull markets. Half the patterns in bear markets will fail to drop more than 25%. In bull markets, the halfway mark passes at 14% not shown, meaning half the patterns will fail to decline more than 14%. Compared to other bearish chart patterns, these failure rates are small. However, notice how the failure rates climb rapidly when we allow the maximum decline to change from 5% to 10% and higher. One way to use the table is with the measure rule. Later, in trading tactics, I discuss the rule, but suppose it predicts the decline of a stock from $20 to $15 after the breakout. That 5-point drop is 25% of the price of a $20 stock. How likely is it that price will actually decline that far? Table 15.3 shows the answer. In bull markets, 78% will fail to drop more than 25%, and in bear markets, 58% will fail to make it down that far. Thus, in both markets, price is unlikely to reach the target. That's an average, so your results will vary. Table 15.4 shows breakout-related statistics for bar tops. Breakout direction. By definition, bar tops have downward breakouts. A breakout occurs when price closes below the up-sloping trend line at the bottom of the pattern. Yearly position performance. Where do the best-performing bar tops break out? And I'm not talking about acne. The star performers have breakouts near the yearly low. To put it another way, avoid trading bar tops with breakout prices within a third of the yearly high. They perform worst. Pullbacks. A pullback occurs almost 2/3 of the time, and it takes about 2 weeks for the stock to return to the breakout price. That means price drops for a week, ending 6% to 9% below the breakout before starting the return trip on average. Notice that when a pullback happens, performance suffers and suffers dramatically. Once the pullback completes, the stock resumes the downtrend over 60% of the time on average. Check for underlying support nearby, anything that might send price higher. If you short a stock and price heads back up, it may be a temporary situation caused by a pullback. Price should return to or come close to the breakout price before resuming its downward move. If price continues higher, close out your short position. If price continues down, consider adding to your short position or opening a new one. Gaps. This is odd. Gaps hurt performance. Trading lore says that a breakout day gap helps performance, and we've seen that in other chart pattern types. Note that the performance difference between gaps and no gaps is 1 percentage point, so the differences are probably not statistically significant. Number of dual bumps. Sometimes price will bounce off the trend line and form another bump. That is what I call a dual bump. Compare figure 15.3 with figure 15.4. The stock in figure 15.3 has a bump with a rounded appearance, giving investors plenty of time to sell the stock near the high. Figure 15.4 shows a chart pattern with a much narrower peak. Investors had only a few days to catch the top before price moved down quickly. The chart in figure 15.4 is also a dual bar, 2 or more bumps. There is a second, smaller bump just before price heads below the trend line. Dual or multiple bump bars occur 18% to 21% of the time. Table 15.5 shows size statistics. Height. Bar tops don't see a big performance difference between tall and short patterns. Bull markets do show a difference, 2 percentage points, but the bear market shows the reverse, short patterns doing better. I computed the difference between the highest high in the pattern and the lowest low, and then divided the height by the breakout price. Values above the median I considered tall. Values below the median mean the pattern is short. As a general rule, stick to trading tall patterns. Width. Again, results are mixed and probably not statistically significant anyway. I used the median length as the divider between narrow and wide. Because wide patterns tend to do better than narrow ones, as a general rule, in other chart pattern types, I would stick to picking wide ones. Height and width combinations. In bull markets, tall and narrow patterns do well. In bear markets, short and narrow ones outperform. You'll want to avoid short and wide ones though. They show the worst performance across bull and bear markets. Table 15.6 shows volume-related statistics. Volume trend. Measured from the start of the pattern to the end, linear regression on volume indicates that volume trends upward throughout the pattern. Does volume really matter to performance? Let's take a look. Rising/falling volume. Bars with falling volume performed better than did those with rising volume. That's especially true in bear markets. Breakout day volume. I don't see a lot of difference in performance for breakout day volume. In other words, a volume spike higher than the prior 30 days doesn't change performance much and hurts it in bull markets. I don't show table 15.7 how often stops hit, because the way my computer calculates the stop location, the results are meaningless for bars. Table 15.8 shows the performance over 3 decades, performance over time. Performance doesn't vary much over the last 30 years. The 2000s were the worst performers, and the best was during the 2010s. Failures over time. I counted the number of times price failed to drop more than 5% after the breakout. The 2000s showed the highest failures, and the 1990s had the fewest. Table 15.9 shows busted pattern performance. Busted patterns count. Comparatively few patterns bust, especially in bear markets. Busted occurrence. Sorting the bust type into single, double, and more than twice triple plus, we see single patterns happen the vast majority of the time. Double busts are few. Busted and non-busted performance. I don't have values for non-busted patterns because there is no such pattern. What remains is the comparison of single busted patterns to all 3 types, single, double, and triple plus. Single busted patterns perform best. I can say that the average rise for all chart pattern types is 42% in bull markets and 28% in bear markets. So single busted patterns perform better than the averages. Trading tactics. Table 15.10 lists trading tactics for the bar top. Measure rule. Figure 15.5 shows the measure rule in action. You can use the bottom of the pattern at pattern start as the target. The bottom portion of the table shows how often price drops that far. You can also calculate the pattern's height, or a multiple of it, from highest peak to lowest valley in the pattern, and subtract the height from the pattern's breakout price. The bottom portion of the table shows the success rate. For example, using the full height of the pattern, price will reach the target in bull markets just 17% of the time. That's why the bottom of the pattern is a better choice for a nearby target. Another method is to calculate the lead in height by splitting the formation along the trend line into 4 equal parts. In the first quarter of the bar, compute the height from the highest high to the trend line, measured vertically, or use the tallest distance between the two. Subtract the result from where the trend line is pierced, heading down the breakout. In figure 15.5, the lead in height is 3.50, that is, 21.5018. The target price is thus 21.63, 25.133.50, reached during the week of the breakout. After the breakout, the stock rises back up to meet the trend line before resuming its decline in this example. Since a trend line denotes a resistance area when approached from below, it is no surprise price turns away. Price forms a double top in the July to September period and plunges downward. Once you have a target, convert the potential drop into a percentage of the current price and compare the results to table 15.3. For example, the drop in the above example is 3.50 and we'll use the breakout price, 25.13, as the current price. The 3.50 drop is a decline of 14%, 100 times 3.50/25.13. Is 14% reasonable? In bull markets, according to table 15.3, 53% will fail to see price drop more than 15%, the closest to 14%. About half the trades will see price drop more than 15%, and half won't make it that far. Warning and sell lines. As you view your stock charts periodically, some stocks will follow trend lines upward. These are the ones to monitor closely. Occasionally, one will begin a rapid climb on high volume and enter the bump phase of a bar top. By definition, a bar is only valid when the bump height, as measured from the highest high to the trend line, is at least twice the lead in height. 2 lines parallel to the trend line assist in that determination. The first line, called the warning line, is lead in height above the trend line. A second trend line, parallel to the first two and lead in height above the warning line, is the sell line. The warning line serves as a signal that a bar may be forming. Once price moves solidly above the line, consider doing any fundamental or technical research on the stock to prepare for a sale. By the time price touches the sell line, you should have a firm grasp of the company, industry, and market outlook. The sell line is not an automatic sell trigger, but it does confirm that a bar is present. A sell line touch indicates that the momentum players have the upper hand. The game could continue for several weeks or months before the downhill run phase sets in, so do not be in too much of a rush to sell. Since most bumps' peaks appear rounded, there is ample time to sell the stock. By waiting, you are giving the momentum players additional time to push the stock even higher. However, there are situations when you will want to sell quickly. If the company, industry, or market look dicey, then perhaps it is time to take profits. You might not be selling at the exact top, but you never go broke taking a profit. Also, if the bump does not appear rounded, then consider selling. A quick decline often follows a quick rise. Figure 15.5 shows the bar trend line and the parallel warning and sell lines, each line lead in height from the other. The chart is on a weekly scale, and it emphasizes the relaxed nature of some bars. If you owned the stock depicted in the figure and sold it when price pierced the sell line moving down, you would not have sold at the top. However, you would have avoided the 40% decline that followed. The decline also points out that it can be easy to make money on paper, but difficult to keep it. Sample trade. Jenny is a librarian. Before she goes home at the end of each day, she logs onto the internet and checks her stock portfolio. She did not notice it at first, but by mid-September, Jenny spotted a bar forming in a stock she owned, figure 15.6. She spent an hour searching the internet for anything she could find about the company. She checked the fundamentals, analysts' recommendations, insider buying and selling, and anything else she could think of. She reviewed the reasons she bought the stock. Using the Peter Lynch style of investing, that of buying a stock one is familiar with, held a special appeal to her. She liked shopping at the grocery store chain, and the products they sold were something she could really sink her teeth into. She felt comfortable owning the stock. Jenny printed out the price chart and examined the bar in detail. She drew the trend line along the bottom, divided the length of it into 4 equal parts, and computed the lead in height. Then she drew the warning and sell lines parallel to the trend line, each separated by the lead in height. She computed the target price to which the stock was likely to decline. From the current price of 30, the target price was 23, a decline of almost 25%. Even though she still liked the stock, such a large decline made her nervous. She looked back through the chart price history and searched for support zones so she could better gauge the area where any decline might stop. The first support area was in the 23 to 24 zone, where a prior advance had paused. Interestingly, that was also the predicted target for the stock. If the stock fell below support, she noticed a second, more robust support area between 20 and 22. What of the possible reward? How high could she expect the stock to rise? Long-term price charts were no help as the stock was making new highs almost daily. Jenny shrugged because there was no way to determine where the rise would stop. Her only guess was that it might pause at 35, 40, or 45 price points where investors might decide to sell round number resistance. Any one of those points could point the stock down, she decided. Even the current 30 level might be the highest price the stock would see. After her analysis was complete, she was still confident that the stock held promise of additional gains. She decided to hang onto the stock. If the stock declined to the warning line, she would sell it. She placed a stop-loss order at 27.50, the current value of the warning line. During late September and into the start of October, the stock followed the sell line upward. On 12 October, the stock jumped up again. After a week or so, Jenny was able to draw another sell line parallel to the original bar trend line that intersected stock price. She decided that should the stock fall to the lower sell line, she would dump the stock. She raised her stop-loss order to 31. The stock did not return to the lower sell line. The stock reached a minor high of 34.38 on 19 October, then retraced some of its prior gains. It curled around and reached a low of 32.88 before turning around. Jenny printed out another price chart and drew a new trend line. This line had a slope of about 60 degrees. She smiled as the bar was performing exactly as predicted. During the first part of December, price pierced the 60-degree trend line when the stock began moving sideways. Jenny suspected that the rise was nearly over, but one could never tell for sure until it was too late. She decided that should the stock decline below the latest sell line, she would close out her position. The stock moved up again. A few days after Christmas, the stock reached a new high of 39.75, and Jenny was able to draw another sell line. During the next 2 weeks, the stock declined to the lower sell line, then rebounded to challenge its recent high. On 15 January, the stock peaked at 39.88, a smidgen below the 40 resistance number she estimated earlier. To Jenny, the day looked like a one-day reversal, but she could not be sure. Taken together, the two highest points looked like a double top. The pattern was a warning, and it made her nervous. Less than a week later, the stock declined below the lower sell line. Should she sell or hold on for additional gains? She looked back at the profit she had made so far and decided not to be greedy. She sold the stock at 36.75 on 22 January. The next trading day, the stock closed up 1.25 at 38, and she was crestfallen. She continued to monitor the stock and watched it hesitantly move higher over the next 2 weeks. She tried to take solace in the large profit she achieved, but it was little comfort in the face of missed gains. Did she sell too soon? On 23 February, her question was answered when the stock dropped below her sell price, heading down. Jenny watched the stock drop to 35 and find support at that level. Then, it continued moving down. In early April, the stock declined below the original trend line, and she calculated the minimum target price of 31. This was reached within the week, and the stock continued falling. She turned her attention to other interesting patterns and forgot her trade until July 1994. By chance, she pulled up a chart of the company and was horrified to see that the stock had declined to a low of about 21, almost a 50% decline from the high. End of Chapter 15. Chapter 16, Butterfly Bearish. Results Snapshot. Appearance, looks like a big W with the location of turns governed by Fibonacci ratios. The bearish butterfly is a Fibonacci-based pattern whose turns are dictated by Fibonacci numbers. I measured performance of Fibonacci-based patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an up or down breakout. Therefore, the layout of this chapter is different from most other chapters in this book. The above results snapshot shows a chart pattern that underperforms when compared to other Fib patterns. The average drop in bull markets is 13%, which is below the average drop of 15% for non-Fibonacci-based patterns. Both measure the drop to the ultimate low, but start from different points. Fibonacci patterns use the high at point D, and regular-based patterns use the breakout price. Bear market patterns perform substantially better, with declines averaging slightly over 20%, but that's still short of the 22.2% average decline of non-Fibonacci-based patterns. That's an apples-to-apples comparison, but the butterfly was meant to predict a turn at point D and see price drop from there. How well does that notion work? One measure shows that price turns down at D at least 85% of the time on average, so if you can find this pattern, you will know at what price the stock is expected to turn lower. That's invaluable information. We'll investigate how far down price is expected to drop in the statistics portion of this chapter. Until then, let's capture a bearish butterfly and see what it looks like. Tour. Figure 16.1 shows one example of a bearish butterfly chart pattern. After a strong move higher, which started in December 2018, price began forming the pattern at minor high X. A retrace followed that took price down to the second turn, A. Price recovered to B, and that location was determined by a Fibonacci ratio of leg BA to XA. After B, point C was another Fibonacci-based turn found by the retrace of leg BC to BA. We'll discuss that in more detail in the next section. Wrapping up the pattern was point D, which used a Fibonacci extension of the BC move to find the turn. Price took a while to turn downward, but it did when it made a strong move lower to bottom at G. The recovery was quick though, with price ending the day near the top of the price bar at G, followed by an upward breakout at E. Volume F trended downward as the chart shows, and that's typical for the pattern. From a swing trader's point of view, this butterfly would be difficult to profit from by shorting the stock. The drop to G was just too fast. Of course, this chart is just one example of a bearish butterfly, but it does serve as a warning that making money with this pattern could be more difficult than with other Fibonacci-based patterns. Let's dig into the identification guidelines so we can spot butterflies in the bush. Identification guidelines. Table 16.1 shows the identification guidelines. Refer to figure 16.2 for another example of a bearish butterfly. I show the butterfly pattern at turns X, A, B, C, D. The stock drops from D like it's supposed to and makes a strong push lower, closing below the bottom of the pattern at E and staging a downward breakout. Unfortunately, price drops only 3% to F before beginning to recover. The stock wobbles on its way to G, where it busts the downward breakout. For swing traders, the move after F isn't as important as the turn at D and the drop that follows. In fact, if you know when a downturn is likely to happen, then you can prepare short the stock, buy protective puts on a long position, sell the stock outright, or just cower in the closet, biting your fingernails as your position starts losing money. Appearance. Bearish butterfly loosely resembles a big W or a double bottom with somewhat tall sides on both ends and a twin bottom that won't share the same price. Some butterflies look like double bottoms, and some, like the one in figure 16.2, resemble an ugly double bottom, that is, a double bottom where the right bottom C is much higher than the left one. BA/XA retrace. Locate point B by computing the Fibonacci ratio of leg BA to XA. Because this pattern is so complicated, I used the high-low price range of the last point B in the ratio. For example, X has a high price of 58.81, the low ATA is 53.14, and the high-low range of B is 57.81 to 56.69. Using the high price of B, we get 57.81 53.14 slash 58.81 53.14, or 0.82. Substituting the low price at B in the equation gives a number of 0.63. Because the range of 0.63 to 0.82 encompasses the target 0.786 Fibonacci retrace, the location of point B qualifies as valid. Your software may use other algorithms for pattern recognition, so don't be surprised if your bearish butterflies are different from the ones you see in this chapter. BC/BA retrace. In a similar manner, I qualify turn C. The ratio is governed by leg BC to BA. The high-low range of point C is 57.65 to 55.50. Result would be, using the high price at B and the low at C, 57.81 55.50 slash 58.81 53.14, or 0.495. Using the high at C gives a value of 0.034. The 0.034 to 0.495 range must span one of the Fibonacci numbers listed in Table 16.1. It swallows the 0.382 value, so point C is fine. DC/BC extension. You might think that for point D, I'd use the same method as in prior ratios. You'd be correct. The high-low range of point D is 60.46 to 59.64. The extension uses the high at B, low at C, and the D high-low range. That is, 60.46 55.50 slash 57.81 55.50, or 2.15. Using the low at D gives 59.64 55.50 slash 57.81 55.50, or 1.79. The range of 1.79 to 2.15 includes the Fibonacci number 2, so point D is valid also. DA/XA extension. I calculate the DA/XA extension differently. In this case, I use a 3% window, 3% above to 3% below the price of D to qualify a 1.27 Fibonacci number. We use the high at D, low at A, and high at X. Thus, we get 60.46 53.14 slash 58.81 53.14, or 1.29. The 1.29 value must be within 3% of 1.27, which it is. This completes the dorking with Fibonacci ratios to qualify the pattern as valid. Volume. Volume trends downward the majority of the time, as we'll see in Table 16.2. Do not disqualify a bearish butterfly just because volume trends upward, unless you feel like it. The volume trend is not a requirement of a valid butterfly, just an observation. The volume trend in figure 16.2 is downward H, as measured between points X and D using linear regression. Often you can tell the volume trend just by looking at volume. Duration. I limited butterfly patterns to 6 months or less, but that's an arbitrary limit I use for most chart patterns. Focus on failures. Figure 16.3 shows a bearish butterfly at turns X, A, B, C, D. The butterfly is part of a rounded-looking turn, rounded bottom chart pattern, starting from the high at H. It's not a pretty turn because the bottom isn't as smooth as I like to see, but it's there. Regardless, the butterfly acts as a reversal pattern when it appears at the bottom of the turn. Price rises to D, completing the pattern, and then turns downward at D, just as it's supposed to. Unfortunately, the drop from the high at D to the low shorting the stock, but how would they know ahead of time? The stock recovers and breaks out upward at F, staging an upward breakout of the butterfly pattern and seeing price soar to a new high. The rounded bottom completes, and price rises about 10 points above the high put in at H. The stock forms a very pretty head and shoulders top as the chart shows. The pattern confirms as valid when price closes below the neckline, the near horizontal line. A pullback at I allows traders a small amount of time to recognize the bearishness of the head and shoulders top before the drop begins. After the pullback ends, down the stock goes, plunging like a cliff diver into the October water. If I were to short a stock, the drop from I is the kind of bearish move I would love to see, not the meager drop from D. This bearish butterfly fails because price drops less than or equal to 5% from the peak at D. The meager decline is what I call a 5% failure. As timely as the bearish head and shoulders is, a bullish double bottom appears at AC, signaling an upward move. Notice that C is slightly above A. You see that kind of behavior near the bottom of rounded turns where price reaches bottom and makes a determined push higher only to collapse and bottom just above where it started. In other words, that's the move from A to C. Maybe the way to notice a potential butterfly failure is to look at the context of where the pattern appears. The rounded turn is a bullish chart pattern. Of course, there's no guarantee that the stock would complete the turn and continue upward. A rounded turn might form a second peak, opposite H, and create a double top when price tumbles. That's what I would have expected, and with a bearish butterfly in the way, I'd assume price would reverse at D. If the bearish butterfly appeared a bit higher in the rounded turn, then that would have been a distinct warning of an impending decline. As the chart shows, that didn't happen. A check of the fundamentals news, like earnings announcements, might shed some light on why the stock continued its march upward from the low at C. So there you have it. This bearish butterfly fails to see price make a sustained turn lower at D, disappointing traders who may have shorted the stock near the D peak. Statistics. Table 16.2 shows general statistics for the bearish butterfly. Number found. I found 1230 bearish butterflies in my home office. That came from 662 stocks with patterns found between August 1991 and August 2019. Not all stocks covered the entire range. And yes, that includes stocks that no longer trade. I know you've been wondering about that. Break-even failure rate. The failure rate counts how many butterflies fail to see price drop more than 5% below the peak at D. In bull markets, the break-even failure rate is an impressive 27.3%. Wow, compare that to the 7.6% rate for bear markets. I suggest you avoid trading this pattern in bull markets unless you have special sauce you can add to the stew to get this pattern to be more palatable to your portfolio. Average decline. Numbers in the table say that for the best performance trading this pattern stick to bear markets. However, both bull and bear market numbers fall short of what non-Fibonacci patterns average. Volume trend, performance. I used linear regression to determine the slope of volume and found it trends downward most often. Numbers are just above random. Even so, the performance benefit isn't much and you have to pay attention to the volume slope upward in bull markets and downward in bear markets. Trading tactics. Some of the numbers already discussed compare the performance of the bearish butterfly with regular non-Fibonacci-based chart patterns. However, the focus for this pattern is really with the swing trader. They seek to short the stock at the end of the pattern or sell a long holding. Here are some statistics that help define the performance at and after D. Table 16.3 shows how price behaves after a bearish butterfly completes, using numbers too. Isn't this exciting? How often does price turn at D? One of the tenets of this pattern is that price will turn downward at D. The statistics in the table prove that's true nearly all of the time. A new question arises: how far does price drop after D? How many drop to point? I used the pattern's turns and tabulated how often price reached those turns. For example, I found that price dropped to point C between 38% bull market and 44% bear market of the time. Hopefully, you can use these locations to help gauge where price will turn upward and give you a clue when to close out a trade short sale or maybe enter a new one long side. Before making a trade using this chart pattern, we see from table 16.2 that the average decline in bull markets is 13%. You might compare that to the location in your butterfly to see where it matches with the ZABC turns, measure 13% down from the peak at D. Then use table 16.3 to look at the probability of the stock dropping to that turn. You'll have to make an evaluation if the reward is worth the risk of a trade. Sample trade. Figure 16.4 shows a trade Susan made using a bearish butterfly. The butterfly is at X8BCD on the chart. She didn't care to short the stock at D. She's not that experienced, and the profit potential wasn't appealing to her anyway. How did she weigh the profit potential? She used table 16.3 as guidance and suspected price wouldn't make it down to A, just 24% due. She watched the stock drop from D to break out downward at E and coast lower to F. The stock bounced and made a second low, a higher low, in late August. Then it was off to the races when price climbed and reached G. Why was G important? I asked her. Because the drop from A to F was less than 10%. Close above the top of the pattern at G busted the downward breakout. Busted patterns can produce outsized gains, but only if Mars is in alignment and it's a full moon. She reached over and rested her hand on my arm. I'm just kidding about that last part. Susan bought the stock a day after G and received a fill at the opening price of 39.82. She didn't have a target in mind. Rather, she wanted to make as much as possible on the trade, preferring to let the stock speak to her. It would let her know when it was time to get out. I know, that didn't make a lot of sense to me either, but when she started talking about astrology and the alignment of the planets, I tuned her out. The stock really didn't cooperate at the start. It rounded over and retraced, but that was typical for a stair-step move higher. It didn't frighten her out of the stock. She had hoped that the continuation or breakaway gap shown a few days before G would provide support, and it did. Phew. She told me. I put a stop at 36.63 below the gap. On the chart, I show at H the little nubbin under which she tucked her stop. Once the retrace finished, the stock started moving higher again, leaving behind a pattern called an inverted and ascending scallop, the arc at H. Price continued higher, forming another scallop at I, and then a third at J. She recalled reading in one of my books about scallops, how as they appear higher in the price chart, they tend to get shorter and narrower. When three stack up showing those traits in the same uptrend, a trend change is more likely. For grins, she computed the retrace of each scallop and found that the first one measured 38% H, scallop I came in at 47%, and J was at 48%. In other words, price was retracing more each time the scallop appeared higher in the price chart. That was additional evidence that price was going to reverse. Did it reverse? Not immediately. Price was a firework rising from L to K in a straight line run-up. And it began backtracking. Despite the run-up, she expected the stock to turn lower, based on the three scallop pattern signaling an end of the upward run. Plus, Mars was in alignment with Las Vegas or something. She set a retrace of 50% of the L to K rise as her exit price. She reasoned that if the stock really wanted to climb again, it would turn higher before retracing 50%. She placed a sell order at 52.75 and that filled at M. On the trade, she bought at 39.82, sold at 52.75, and made almost $13 a share or 32%. If she traded the busted butterfly perfectly, she would have bought at 39.51, a penny above D, and sold at the high 57.32K for a gain of 45%. She called me on the phone and yelled, "Party time, I get along great with Capricorns, let's go." I asked, "Mom, is that you?" End of chapter 16. Chapter 17, Butterfly Bullish. Results Snapshot. Appearance, a 5-turn pattern governed by Fibonacci ratios, often looking like a big M. The bullish butterfly is a Fibonacci-based pattern that depends on price turning upward at the end of the pattern. Fibonacci-based patterns are ideal for swing traders who make money in the short term as price roller coasters. I measured performance of Fib patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an up or down breakout. Therefore, the layout of this chapter is different from most other chapters in this book. When compared to other non-Fibonacci-based patterns, the above results snapshot shows below average performance for the move after turn D. Failure rates are lower though. including the delicious 2.6% rate of those failing to see price rise more than 5%. That's exceptionally low ranking in first place, by the way. It suggests price forms a trend long enough for swing traders to make a profit. Let's take a tour to see what the pattern looks like. Tour. Figure 17.1 illustrates a good example of what a bullish butterfly looks like and how it's supposed to behave. I show the butterfly as points X, A, B, C, D. Price begins a downtrend at F that leads to the start of the butterfly at X. Price bounces up to A in a short move higher, drops just as fast down to B, retraces a portion of the AB move on the way to C, and completes the pattern at D. Volume E trends upward in this example. What I find odd about this butterfly is how compact it looks. Usually the turns are more spread out, but not this time. It's as if the bulls and bears were yanking each other around for control of the stock. Price bottomed at D and then took off, rising in short order to G. That wasn't the ultimate high, though. The stock found the ultimate high in June 2014 at a price of almost 27 for a potential gain of 50% above the low at D. If you were a swing trader and butterfly catcher, you had just a few days to buy into the stock after the D bottom before price zipped higher. If you'd planned to sell at the top of the pattern A, you'd have missed out on a nice and fast move to G. Let's learn how to find bullish butterflies without going to the zoo. Identification guidelines. Table 17.1 shows identification guidelines for the bullish butterfly. Refer to figure 17.2 as I walk you through how my software identifies the patterns. This butterfly, shown as turns X, A, B, C, D, breaks out downward at F when price closes below the bottom of the pattern. However, a swing trader wouldn't worry about that. It would be timing the entry at D and riding the stock upward, trying to capture as much of the rise to G as possible. Appearance. A perfectly looking bullish butterfly might remind you of a creature with two wings, the first wing being highlighted by lines connecting turns X, A, B, and back to X, and the second wing by lines connecting B, C, D, B. They join a body at B. However, in the real world, you'll see some mutant butterflies. The various turns in the bullish butterfly are governed by Fibonacci ratios. Let's go through each one to show how I find them. AB/AX retrace. I use the ratio of the various turns to see if the result is near a Fibonacci number. In these computations, I use the high-low value of the last point. You'll see what I mean. The low price at X is 19.40, the high at A is 29.05, and the high-low range at B is 22.19 to 20.94. AB/AX ratio becomes, using the low at B, 29.05 20.94 29.05 19.40, or 0.84. Using the high at B, we get 29.05 22.19 29.05 19.40, or 0.71. The span of 0.71 to 0.84 encompasses the 0.786 target Fibonacci number from table 17.1, so B is a proper turning point for the pattern. CB/AB retrace. Similarly, I find the CB retrace of AB using the high-low range of C, 26.96 to 25.62, and the high at A, low at B. Plugging the high at C into the equation, we find 26.96 20.94 29.05 20.94, or 0.742. Using the low at C, we get 25.62 20.94 29.05 20.94, or 0.577. The range 0.577 to 0.742 must span at least one of the numbers listed in table 17.1. Two numbers qualify, 0.618 and 0.707, so turn ABC qualifies as valid, CD/CB extension. I find the extension the same way, using the high-low range of the last point D in this case. D has a high price of 18.47 and a low of 17.01. Plugging in the numbers gives a span of 1.41 to 1.65. The 1.618 number squeezes into the range, so we found point D. AD/AX retrace. Because Fibonacci-based patterns are so complicated, I use the high-low range as discussed to qualify the turn, except for AD/AX. For this ratio, I use a 3% window. I use the high at A, low at D, and low at X in the formula, which gives a value of 1.25, which is within 3% of 1.27. Thus, we have a valid bullish butterfly whose turns come close to the Fibonacci numbers listed in the table. Volume. We'll have a report on volume later in the statistics section, but volume trends downward most often as measured from the start of the pattern X to the end D. That's in bear markets. The volume trend in bull markets is about random duration. I limited patterns to 6 months or less, but that's an arbitrary limit. In this example, the stock climbed after turn D, as predicted, but only made it up to G before reversing. We'll discuss statistics later to see if we can better gauge how far price might climb after the pattern ends. Stay tuned. Focus on failures. Figure 17.3 shows a bullish butterfly with its 5 turns, XABCD as shown. In a violent reversal at F, the stock formed a needle-sharp V-top chart pattern and plummeted to find footing at X, the start of the butterfly. Price, in a series of undulating waves, climbed to A before another sell-off ensued. That selling carried price down to B. Another recovery and sell-off dropped the stock to D. Swing traders wishing to participate in the recovery may have bought during the week after D. They had plenty of time as the stock slid sideways and made a nice tight knot of support. Volume not shown moved sideways from X to D, with no outstanding peaks that would hurt the feet of anyone stepping on it. The key to the failure of this pattern is what happened at D. I didn't check for news, but when the stock broke downward through support, that was the exit signal for those who bought at D and hoped to see price climb. The plunge to E was a straight line affair that had an even faster recovery back up to the price of D. The support at D, now resistance, repelled the stock and forced it back down. It took 2 more tries to break through the ceiling set up by that knot of resistance. Those who bought at D in anticipation of a rise were disappointed. Perhaps you heard their screams when they sold for a loss. If they'd held on, they would have been rewarded when the stock began its recovery in May. Unfortunately, being rewarded for breaking the rules is one of the struggles newbie traders have to overcome. If they broke their own rules and held on as price dropped, only to be rewarded during the recovery, they might be tempted to hold on too long the next time. And that's how a bad habit forms, one that will drain their wallet or purse as sure as the sun rises the next day, when the stock drops and stays down. The utility stock climbed to 48 in 2007 before the bear market came along and delivered a knockout punch to stockholders. Returning to the turn at D, fortunately this type of behavior for many Fibonacci-based patterns is rare. Price does turn upward at D nearly all of the time. For the bullish butterfly, that means at least 88% of the time. Accompanied by a low failure rate, capturing the upward move from a bullish butterfly might be a good tool for swing traders to have in their toolbox. Let's crunch the numbers and see what they reveal about the behavior of bullish butterflies. Statistics. Table 17.2 shows general statistics for the bullish butterfly. Number found. I found few patterns, a total of 882 in both bull and bear markets. I dug them up in 601 stocks from July 1991 to June 2019. Not all stocks covered the entire period, and some no longer trade. Break-even failure rate. The failure rates for the bullish butterflies are low, especially in bear markets. Why the failure rate is so low is a mystery. The bear market should be sucking price lower, even as price climbs upward after turn D. You'd think that a count of patterns failing to gain more than 5% of altitude would be high, but it's not. A check of the spreadsheet shows everything in order. There were 152 patterns involved in the computation, which is short of the 173 bear market samples. That's because the remainder didn't turn upward at D, they continued lower, and so are not counted. Perhaps the dearth of samples is the reason for the low failure rate. Average rise after D. The table shows the average rise as measured from the low at D to the ultimate high. The ultimate high is the highest high before price tumbles by 20% or before the stock closes below the low at D. Even though the numbers are below average compared to non-Fibonacci chart patterns, they are high enough for short-term minded swing traders. Volume trend performance. In bull markets, the volume trend is about random. In bear markets, the pattern has an upward volume trend. That's a bit odd because most chart patterns see volume recede. Bull market performance is probably not statistically significant, but the bear market numbers show a wide performance difference. Samples are few, 77 for up volume and 75 for down, giving a 6 percentage point performance spread between 31% and 25%. In short, in bear markets, look for upward trending volume for the best performance. Trading tactics. A bullish butterfly is for swing traders who can use the Fibonacci ratios to calculate the price where turn D will appear. Then they can wait to buy when the turn is in place. After that, all they have to do is sit back and collect their money as it tumbles in. Okay, so it's not really that easy. How easy is it? The following may answer that question. Table 17.3 describes the behavior after the pattern ends. How often does price turn at D? If price doesn't reliably turn at D, then traders are wasting their time chasing butterflies. However, the bullish butterfly doesn't disappoint. The average stock will turn upward at D at least 88% of the time. However, once they turn, how far does price rise? How many rise to? I mapped the rise for each butterfly and compared it to turns A, B, and C. For example, I found that for those making the turn at D, the stock climbed to A 39% of the time in bull markets and 15% of the time in bear markets. Point A, as you will recall, is at the top of the butterfly. In bear markets, you'd expect the stock to struggle to reach the top of the pattern. In bull markets, with the market current pulling the stock upward, price is more than twice as likely to reach A than in bear markets. Remainder of the table shows how often price rises to the other turns. Sample trade. Figure 17.4 shows a trade Mary made using a bullish butterfly. The pattern's turns are labeled XABCD, as you might expect. Her pattern-finding software found the pattern for her within a week after turn D. Volume trended downward E throughout the pattern, but the trend wasn't significant to performance in bull markets. I did my homework on the stock and liked what I found. At F, she bought at the open and received a fill at 45.19. The stock cooperated and didn't just move higher, it became a rocket. Price day after day formed higher highs and higher lows. When the stock reached the top of the pattern, she knew it might stall there and form what's called a 2B pattern. It's not covered in this edition. A 2B pattern happens when price makes a new high but fails to follow through, meaning price doesn't rise far above a prior peak before reversing. If price drops far enough, it'll form a double or triple top. At other times, price will retrace a bit and then try for another high. In this case, with the stock moving up so fast, she placed a trailing stop a penny below the prior day's low. After 3 consecutive days of higher highs and higher lows, the technique is a good method to exit near the end of an uptrend. At line G, when price reached the high of A, she started using the trailing stop. Took her out of the stock on the day the stock peaked H, but her stop was at 50.62, a penny below the prior day's low. On the trade, she made $5.43 a share for a 12% gain in 10 days. On an annualized basis, that's over 400%. Very nice, she said. To celebrate, she told me, you can buy me dinner. End of Chapter 17. Chapter 18, Cloudbanks. Results snapshot. Appearance. Years of overhead resistance form a flat base followed by a significant decline. This chapter has a different format than other chapters in this book due to the nature of the Cloudbank pattern. Cloudbanks are best for people who buy and hold for years, not for shorter-term swing traders who enjoy being stopped out, that is, who use stops. Because a monthly scale is used to measure performance for Cloudbanks, I do not provide a rank for other chart patterns, is based on the daily scale, so any comparison is an apples and oranges thing. How many times have you switched to the monthly scale and searched for chart patterns? You'll see some of your favorite patterns on the longer-term scale, double tops and bottoms, a few triangles, and maybe this pattern, a Cloudbank. If you like to invest, it might be a pattern worth finding. It's one of my favorites. Tour. Figure 18.1 shows what a Cloudbank looks like, shown on the monthly scale. The base of the cloud forms from 2003 to 2008, although the actual price trend isn't as flat as the horizontal line indicates. Indeed, price wobbles up and down during the period, yet there's a horizontal component to that movement as price slides sideways. That sideways move is what you're looking for when searching for Cloudbanks. After price starts dropping in the bear market, it tunnels through support and down it goes, following the rest of the market lower. This stock held up better than the market indices. The bear market started in October 2007, and this stock held on until September 2008 before the plunge really started. Both the stock and the general market bottomed in March 2009 when the bear market ended. A recovery began, following the start of a bull market. In this example, the rise was swift, taking the stock back into the clouds just 4 months after bottoming. The stock bottomed at 40.87 and reached the cloud base of 67.05 for a gain of 64%. That's a nice recovery. If you only captured half that, the gain would still be a nice prize. Such large gains are typical for Cloudbanks, which is why I like them. The average rise is 386%. Now that's tasty. Unfortunately, it measures from the lowest low to the bottom of the Cloudbank, a perfect trade, or to the highest high until the end of data. The huge gain suggests there's money to be made trading clouds if you're willing to hold on and tolerate the risk. Identification guidelines. Table 18.1 shows the identification guidelines for Cloudbanks. Refer to figure 18.2 as I discuss them. Appearance. Use the figures in this chapter as guidance, but you're looking for price to slide sideways for years before a steep plunge. Scale. Finding Cloudbanks on the historical scale is easy. Switch to the monthly chart to locate them. Figure 18.2 shows two Cloudbanks, A and D. Notice that each price bar represents a month, so there are 12 bars to a year. This scale allows you to find these long patterns, which often stretch for several years before the big drop happens. Cloudbank. Cloudbank A has a nice rounded top, like traders build a geodesic dome. The bottom of the pattern rests on support, which I show as a horizontal line. This example looks compact and tidy, but consider Cloudbank D. The shape of the cloud is irregular and more typical of the cloud pattern. Price rests on support, shown by horizontal line D. Clearly, D is not an ideal example. Consider the cloud base as the normal price of the stock. The big plunge that happens after the cloud represents an anomaly. The cause might be a bear market, or it might be something else like disappointing earnings. You want to be sure, as much as you can anyway, that the stock will recover back to the Cloudbank. If the cause is a bear market, then a bull market should turn things around and support the stock as price recovers. Plunge. The stock makes a large drop, bottoms at B, E, and G. The drop is often swift, taking price down substantially. I use a 40% minimum drop because I want to make a large gain on the recovery. I discard clouds with drops less than 40%. Look at the drop from A to B. In the 2007-2009 bear market, price takes about half a year before it hits bottom at B. And it takes over 2 years to recover to the base of the Cloudbank C. After Cloudbank D, the stock bottoms at E and returns to F. I don't consider E to be the bottom of this pattern, even though it represents a drop of 46%. It just looks like F is a pullback, which is a chart pattern before the downward move resumes. Stock makes a lower bottom at G, and it looks to take as much time to return to H from G as the EF recovery. Events. If the markets are not bearish, then you'll want to check news on the stock. Find out why the stock is dropping. For example, Toys R Us had problems competing with internet retailers and a large debt load that prevented them from updating their stores. They declared bankruptcy, so a Cloudbank trade could have led to disaster. GameStop suffered because people can download games without having to visit their brick-and-mortar stores. They make big bucks from used games, but digital downloading of games is jeopardizing those fat profit margins. Stamps.com suffered after losing an exclusive contract with the U.S. Postal Service. These companies may not recover, so even if they show a Cloudbank, the risk of continued losses suggests avoiding taking a position. Bear market. When I discovered the Cloudbank pattern in early 2010, I thought it was just a quirk of one bear market. Indeed, the 2007-2009 bear market has many Cloudbanks, but as this chart shows, clouds also appear outside of bear markets. The stocks stage their own bear market outside of the indices. Recovery. If the indices continue making lower lows, there's a good chance that your stock showing a Cloudbank will drop too. So don't be in a hurry to buy. You may be able to make a purchase at a lower price. Having said that, most Cloudbanks, 63%, lead to a V-shaped recovery. 17% are double bottoms, 12% are ugly double bottoms, and 8% are horizontal to round out the lot. So waiting on the sidelines to buy means less risk but also potentially lower profit. Focus on failures. How do Cloudbanks fail? 2 ways. Price doesn't return to the bottom of the Cloudbank, or even if it does, it takes too long to get there. Perhaps the most dangerous mistake traders make is buying too soon, before price has bottomed. Figure 18.2 shows an example. The bottom of Cloudbank D is at 28.64 and the stock bottoms at 15.42E for a drop of 46%. That exceeds the 40% minimum drop for Cloudbanks. If you were to wait for price to close above a 4-month simple moving average, you'd have bought into the stock at 21.26 the following month, first open in October. Ride the stock back up to the cloud, and you'd make almost 35%. That's not bad, but it pales to buying in at 12.73, 2 price bars after G, and riding it back up to 28.64 for a gain of 125%. Of course, the G entry requires perfect timing, so don't be fooled. Finding the entry isn't easy. Figure 18.3 shows a Cloudbank nightmare unfolding. During July 2009, the company reverse split their stock, combining 20 shares in return for one. That's why the price on the right of the chart is so high. At B, the stock bottomed and I show an inset of the price bars. Not shown, but a 4-month simple moving average would have triggered a buy at the close of bar A. If you bought at the open the following month, you would have received a fill somewhere near 27.60. 2 months later, you'd be staring at price hitting a low of 8.22C for a potential loss of 70%. Wow. Stock recovered and has climbed to a high of about 67.50. That's a nice return of 145%, but it's a far cry from the bottom of the Cloudbank, 998.20, for a potential gain of 352%. It's been a decade and price hasn't climbed close to the Cloudbank. Statistics. Table 18.2 shows statistics for Cloudbanks. I found Cloudbank patterns in 371 stocks from January 1991 to October 2018. Let's go through the stats one at a time. Number found. My hunt for Cloudbanks found 439 patterns using the monthly scale only. The number isn't an average, even though it's in the average column in the table. Cloud duration. The patterns I found are long, lasting almost 3 years as measured from the start to before the big plunge on average. Drop from Cloudbank to lowest low. The lowest low is point B in figure 18.3. For stocks that had price returned to the Cloudbank, it was the lowest low between the end of the cloud and the date the stock returned to the Cloudbank. For those stocks not returning to the cloud, I used the lowest low to end of data, most of the time. Sometimes price came close to returning to the cloud, so I used the low between that point and the cloud end. The average drop from the base of the cloud to the lowest low was 68% in the stocks I looked at. Drop for those that recovered/did not recover to the Cloudbank. I measured the drop from the base of the Cloudbank to the lowest low. For those stocks that saw price return to the cloud, the drop cloud to lowest low averaged 66%. For those that did not return or haven't yet, the drop was larger, 82% on average. Thus, if your stock has an unusually large drop, anything above 66%, you might want to avoid trading the Cloudbank unless other stocks are showing similar drops. Number recovering to Cloudbank. Most 86% of the stocks I looked at showed price returning to the Cloudbank. The others, like AIG, figure 18.3, have run out of data before making the return trip. Number climbing above Cloudbank top. For those stocks in which price has returned to the bottom of the cloud, just 64% have pushed their way through overhead resistance and poked out above the top of the cloud. Time to slash through Cloudbank. Here's an interesting statistic for clouds. It takes longer to rise through the cloud, 2.8 years, than it does to move from the lowest low to the cloud base, 1.7 years. Once price reaches the cloud, sell and look elsewhere for another trade. S&P 500 change, rise for those reaching cloud base. The rise for stocks returning to the cloud averages 362%, or a median of 178%. That compares to a rise of 47% and 36%, respectively, for the S&P over the same hold time. This measures from the lowest low to the bottom of the Cloudbank. Keep in mind that you won't be buying in at the lowest low, unless you time it perfectly, so your results will average far less than 362%. Rise for all Cloudbank patterns. I measured the rise from the ultimate low to the lower of the bottom of the Cloudbank, or the peak, before end of data. The stock may have moved higher. Indeed, one stock climbed from an ultimate low of 55 cents to $483.86 for a gain of 87,875%. Other stocks showed outlandish recovery prices, too, so I limited the upside to the bottom of the cloud. The table shows what I found. How many change trend? This is a count of how many Cloudbanks see price rise more than 20%. Nearly all of the patterns qualify, perhaps due to the monthly scale and how far price rises to the ultimate high. I measured from the lowest low to the lower of the bottom of the Cloudbank, or as high as the stock has recovered so far. Table 18.3 shows a frequency distribution of those Cloudbank trades that saw price return to the base of the cloud. For example, 21% of the patterns returned to the bottom of the cloud within 6 months. Another 27% took a full year to make the trip. By the end of the third year, 83% had completed the journey. Volume. I don't show a table of volume statistics because there's not much to tell. I found the average volume in the Cloudbank pattern start to end, in the drop leading to the lowest low after pattern end to month before the lowest low, and at the lowest low, using the average of the 1 month. In 80% of the cases, volume was higher during the drop than during the Cloudbank. When price bottomed at the ultimate low, just 44% of the time, volume was higher than during the Cloudbank or subsequent drop. In other words, volume doesn't give a reliable clue when the stock might turn upward for a sustained recovery. Trading tactics. Table 18.4 shows trading tactics. The sample trade provides more detail on how the moving average setup works. Bear market. The majority of Cloudbanks have price that bottoms in or near, within less than a month of a bear market. After the bear market ends, everyone jumps in to buy cheap stocks and the bull market begins with gusto, carrying stocks upward. Measure the drop. As the stock drops out of the Cloudbank, measure how far it has dropped. I used 40% as the minimum drop for a Cloudbank trade. If you buy into a Cloudbank with a drop less than 40%, you risk seeing price continue lower or a small potential profit. As mentioned in Table 18.2, the usual drop below the bottom of the Cloudbank averages 66%, median 64%. However, those Cloudbank trades that struggle to return to the cloud have drops averaging 82%, 86% median. Thus, if your stock is down substantially, more than 66%, it may take an unusually long time to recover to the Cloudbank, if it ever does. Lowest low. If price drops in a straight line run down, that is, price drops month after month with little or no pause or retrace, a 4 or 5 month simple moving average may work well as an entry signal. Wait for price to close above the moving average and buy at the open the next month. Another method is to use a confirmed ugly double bottom chart pattern as a buy signal. Think of a double bottom, except the second bottom is higher than the first by more than 5%, but be flexible. When price closes above the top of the pattern, buy. Set a stop below the price of the first bottom if you can tolerate such a loss. Crossover. If you're using a moving average to time the entry, wait for price to cross above the simple moving average, SMA. I recommend a 4 or 5 month SMA. Tests of 4, 5, 7, and 10 month SMAs show the 4 and 5 month values have the largest gain and smallest hold time loss, the maximum amount of money you might lose if you sold at the worst time. Measure the drop from the base of the cloud to the lowest low. If the stock has dropped less than 40%, wait, the stock may drop more. Otherwise, buy at the open in the next trading session. Hold time. Cloudbank trades are buy and hold investments. If price drops below your purchase price and it's a bear market, don't worry. Most stocks will be hurting, just like the one you bought. Check the news and fundamentals. If they are fine, then hold on. If it is not a bear market, then recheck your work and the reason for buying the stock. If you continue to expect a recovery, then hold on to the position, otherwise sell it. Sell at cloud base. Statistics show that it takes longer to move through the cloud than it takes to reach the cloud. Thus, if the stock reaches the bottom of the cloud or even comes near, however you define near, then consider selling. There are times when the stock is chugging along, making new highs each month. In those cases, hold on and ride the stock through the cloud until price starts moving horizontally or falling. Then sell. Experience. Let me tell you about what I found in my trade review. Northwest Pipe Co. Entry into a Cloudbank for me is often set by when I have the cash and am looking to invest. I think that's the case with Northwest Pipe Co. NWPX. I also mentioned this trade briefly in the chapter on rectangle tops. In 2011 through most of 2012, the stock bounced off support at 19 to 21, forming a Cloudbank. The last touch was in December 2012. After that, the stock climbed to a June 2014 high of over 41. Then it tumbled, dropping to 7.46 in early 2016. The stock recovered up to 12 and moved sideways, forming a rectangle top. From my notebook, chart pattern traded, rectangle top, Cloudbank bottom at 1921. Buy reason, rectangle top. I think the downward plunge from 2014 is over, and this will bounce up after the rectangle breaks out upward. I'll put a stop order to buy at 12.41, I think. This is thinly traded and it's a risk, so I'll buy lightly. Company makes engineered steel pipe water systems. I can't see any growth in that industry. I was hoping the Flint, Michigan, debacle with their corroding pipes would spur some interest in this stock, but I don't see that happening. They closed their Denver facility in mid-2015 and laid off 65 people. Yuck. If we get a downward breakout from the rectangle, then avoid this stock. 22 October 2016. The conditional order triggered 2 days ago for a buy at market open yesterday. It didn't fill anywhere near the opening price, 12.46, filled at 12.70. Sheesh, it filled in the first minute but right at the very top of that price bar. Bad execution. Even so, we had a good run up in the stock going into noon where it went horizontal the rest of the day. News said that on 19 October, the company was awarded a contract to provide Tarrant Regional Water District and Dallas Water Utilities pipe, almost 67,000 feet of 84 concrete pipe. No word on cost. I bought slightly less than half a position with a target of 19 to 21 with a stop at 11.54 for a potential loss of 4.5%. Because this was a long-term holding buy and hold, I didn't place the stop with my broker. About 2 weeks later, I filled out the second portion of the trade by buying again, this time trading a V-bottom chart pattern. See that chapter for the entry. They share the same exit, which follows. The stock climbed but missed the 19 target by 8 cents. It plunged back to 14 and change, only to rise back up to peak at 19.55 just over a month later. I didn't sell through any of those gyrations. The stock dropped to 12.41 and recovered going into 2018. From my notebook, 9 January 2018. S&P says strong sell as of 3 January 2018. Everything is negative: value, quality, growth, financial health, price momentum. Other analysts are red bearish too. Dump this. Insiders are holding on to shares though. Cloudbank is at 20, so right there at the base. On the sell order I wrote, sell reason, this didn't go anywhere this past year, but what scares the willy out of me is the negative analyst view, so I'm going to let it all go. Sell reason, hit Cloudbank base. On the trade I made 51%. Lesson, I was late buying into the trade both in time and price. The turn at bottoms is often V-shaped, whereas peaks are more rounded looking. Try to improve the entry. Lesson, if the stock nears a target within 3%, then consider selling. Second lesson I grabbed from another chapter in this book, but it holds true for this trade too. The stock hit my 19 target in January 2017 and missed it by 8 cents the prior November. I could have met the target and looked elsewhere for another trade, or traded this one again. Instead, I held on and watched the stock drop back to near my buy price before recovering. Of course, this wasn't a swing trade, it was buy and hold. The stock continued higher in large up and down swings, eventually reaching 36.70 in February 2020, but that's still below the top of the Cloudbank. If I held onto the stock longer, I could have almost doubled my money in about 2 years, but that's if I sold at the top, which is doubtful. Dead cat bounce. 3 of my Cloudbank trades ended with a dead cat bounce. American Equity Life Ale started as a nice Cloudbank. I bought near the low and the stock moved up. Then news came. Down 15% on news, the U.S. targeted annuities in Obama retirement rules. The company is the second biggest seller of the products. I happened to check in during the day, saw the news and sold, taking a 2% loss. 4 months later, it broke out upward from its sideways move and hit my target Cloudbank low in 6 months. Lesson, try to better understand the implications an event can have on a stock. Because the stock was down 15% on the news, others voted with their sell orders, just as I did. To me, the news sounded like a company making buggy whips when cars were introduced. Was their way of life ending? I thought so, but time healed the outlook and the stock climbed. In Gap GPS, I was looking for a climb from about 30 where I bought to 36 to 40 as a swing trade back up to the bottom of the cloud. Instead, 10 days after I bought, I sold it. Sell reason, DCB, the news said that SSS same-store sales were pitiful, and the stock was down like 9% after market, so I decided to sell it at the open. That saved me some bucks since it closed over $1 lower. The stock bottomed 34% below where I sold. In NewL NWL, in late December 2017, I bought half a position in the stock on a Cloudbank play to 45. From my notebook, I'm hoping we don't DCB again in 1.5 months. I'm hoping to ride this up to the Cloudbank at 45 and above. The first dead cat bounce was in early November, and I usually avoid taking a position in a stock that shows one for 6 months. Why? Because the percentages are too high that another DCB will happen. From my notebook, date sold, 25 January 2018. Order details, sold all at a few minutes before 10 a.m. after logging in to check on my portfolio. Stock was down 6+ points from prior close on earnings warning and said it plans to sell off assets, close factories, closing up to half of them. Ouch. Lesson, don't take a position in a company with a dead cat bounce within 6 months. Sample trade. I offer 2 sample trades, the first of which I show in figure 18.4. This is a monthly chart of a Cloudbank with a base, A, of about 23. The stock climbed much higher than that within the cloud, but the base of the cloud found support near 23. I tried to find out the reason for the drop that began in August 2011, but news on the company's website didn't go back that far. A 4-month simple moving average, SMA, shows price closing above the SMA at B. That's the buy signal. A trade entered at the open the next month, C, would fill near 12.88. After that, it's a matter of waiting for price to climb back to 23, the base of the cloud. Notice that price dropped as low as 8.81 in 2013, a 32% drop below the buy price, which is a substantial potential loss. But Cloudbanks are buy and hold investments, not short-term swing trades. The hold part means holding your nose and not watching the stock drop. Anyway, the stock recovered and reached the cloud at D. Sell right? No, what's the hurry? If the stock is moving up, why not let it coast higher? You can watch the chart, and if the stock on the monthly scale makes a higher low, hold. If it makes a lower low, then sell at the open the following month. Let's say you'll hold onto the stock until it stops making higher highs. That happens at E. So you sell at the open the next month and receive a fill at 28.34 for a gain of 120%. That's a little less than a 3-year hold time, or 41% annually. Figure 18.5 shows the next trade, but this one uses a chart pattern I call an ugly double bottom. Regular double bottoms are covered elsewhere in this book. See the Adam and Eve combinations of double bottoms. An ugly double bottom occurs when price on the second bottom is more than 5% above the low of the first bottom. Entry is the same as a traditional double bottom, a close above the top of the pattern. The 5% number is arbitrary, so the number is not as important as price making a higher low. If you look at the monthly chart of this stock, daily is shown, you'll see price bottoming near 32. On this chart, however, price forms a higher cloud bank at about 35. Let's use the lower cloud bank because there's where overhead resistance will likely appear. Trouble started in December 2018, according to the chart, when price began to spiral downward like a biplane doing aerobatics. According to the company's website, the company entered into a definitive agreement to divest the Wesson oil brand, announced on 18 December, but it wouldn't occur until sometime in the first quarter of 2019. 2 days later, the company announced second quarter results. The stock bottomed at A, at a low of 20.22 on 26 December. Price recovered to B and formed a higher low at C. Although the bottom at C is not 5% higher than A, it does suggest a recovery. A higher low followed by a higher high is often used as a benchmark of an upward price trend. At D, price closed above the high at B, and that was the entry signal. The following day at the open for a fill near 22.87. Notice that the 4-month SMAE, about 27.70, is well above the buy price. In this example, waiting for price to climb above the SM means giving away a substantial amount of money. Price on this chart has climbed to F, just short of the 32 target, but more recently is above 37. The stock returned to the cloud. If you used the ugly double bottom entry method and sold at the 32 cloud base, you would make about 40%. Using the moving average method in this example would give a potential gain of 16%. Maximum you could have made on this trade, assuming a return to the cloud bank at 32, would be 3220.22/20.22 or 58%. That gain is best case. The realistic profit is much less, depending on your skill at entering the trade and the stock's cooperation in climbing to the base of the cloud or even higher. Along the way, you may suffer a big potential loss when the stock forms a second bottom, as in figure 18.4 with a lower low in 2013. Also notice that each of these cloud bank trades did not happen in a bear market. Bear market trades can be easier. Wait for a large drop, 60% to 70%, and buy when the stock appears to find a bottom. With a 60% sale on the stock, you can take comfort in knowing that you are buying closer to the bottom than the top. All you have to do is wait for a bull market to send the stock higher. Yes, it could take years, but that is how you make the big bucks. End of Chapter 18. Chapter 19. Crab Bearish. Results snapshot. Appearance. Looks like a big W with the location of turns governed by Fibonacci ratios. The bearish crab chart pattern looks like a big W except Fibonacci numbers qualify valid patterns. I'll explain appearance later in this chapter. I measure performance of Fibonacci-based patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an up or down breakout. Therefore, the layout of this chapter is different from most other chapters in this book. The results snapshot shows the important numbers for this pattern, starting with the performance rank. This pattern places first and second in bull and bear markets, respectively. Take a bow. I measured performance from the high at the end of the pattern to the ultimate low, so I can compare performance from pattern to pattern. The break-even failure rate is better than non-Fibonacci-based patterns, too. The break-even failure rate describes a measure that counts how often price fails to drop more than 5% after turn DD is the last point in the pattern. The average drop is mixed, though. The bull market average is slightly worse, but the bear market is slightly better than non-Fibonacci-based patterns. The volume trend is random, really, for both bull and bear markets, 50% for bulls and 51% for bears. The next line in the table may be the most important, the reversal rate when price reaches D. Swing traders will want to see price drop at D so they can short the stock or sell a long holding. The above table shows at least 87% of the time price drops after turn D. We'll see later how far price drops. That's important too. A pattern may have a large reversal rate, but if price doesn't travel down far from there, it's like trying to drive to work on a flat tire, meaning it's dangerous. Let's surf the trading waters for bearish crabs to see what they look like. Tour. Figure 19.1 shows a bearish crab at turns XABCD. Before we discuss the pattern, look at the price landscape. At F, the stock peaks but moves horizontally for several months, forming a flat top. After that horizontal movement, a chart pattern appears. The pattern is the crab or the double bottom at AC. In many cases that I looked at, the bullish chart pattern, such as the double bottom, fails to work as expected or as well as expected. You'll see price rise a few percent and then turn lower, busting the upward breakout. In this case, the bullish double bottom does see price rise but only to D. After that, price tumbles. The move amounted to a rise from B, the top of the double bottom, to D of 13%. That's good for a swing trade but far below the average rise for double bottoms. Be cautious when you see price form a top and a bullish chart pattern appears at the end of that top. It can be a bull trap. Let's talk about the bearish crab. Price drops into the pattern from F, forming the 5 turns XABCD. The turns are set by Fibonacci numbers, which I'll discuss in the next section. Don't depend on the pattern looking like this. Because the Fibonacci numbers vary, the shape of the pattern will look different from example to example. However, if you look at them from across the room, maybe using a large room and squinting, they'll appear like a big W or double bottom with tall sides. At the end of the pattern, price rises to D. Here's the key to Fibonacci patterns. They are supposed to make a substantial turn at D. In this case, being a bearish crab, price is supposed to turn down. That doesn't always happen, but for the crab, the turn rate is very high, at least 87% of the time. The turn rate is the first half of the puzzle. The second half is how far price drops. It doesn't do traders much good if price whips back upward. For the crab, the average decline is weak, 14% in bull markets, but only if you trade it perfectly and often enough. For a swing trader, buying in late and exiting early or late will cut that percentage down, so you may struggle making money with this pattern. It's also possible you could do better, because the 14% number is an average of over 1,300 patterns. If you have a better pattern recognition algorithm than the one I used or employ additional trading tools to filter out duds, then there's money to be made. Even just knowing that price will turn down at D is valuable. In the examples shown in figure 19.1, the stock turned down at D and dropped, gapping lower at E, breakaway or continuation gap, and breaking out of the pattern downward there. The drop to the low in February almost cut the price of the stock in half. Bet that hurt. Identification guidelines. Table 19.1 shows the identification guidelines. Figure 19.2 shows what a well-behaved bearish crab should look like and how it should perform. Appearance. I don't know how the crab name came about for this pattern. What we see in the pattern are a number of tight turns XABC with point D way off in the boonies. That's because the Fibonacci extension for the DBC turn is a long one, between 2.618 and 3.618 of the BC length. Let's talk about how I programmed my computer to find the turns. BA/XA retrace. Retrace BA of the XA move must be one of the Fibonacci numbers listed in table 19.1. To find the value of B, I first picked 2 minor high-low turns X and A, and then searched for turn B. In this example, the high at X was 46.89, the low at A was 41.68, and the high-low range of B was 44.54 to 43.61. I used the high-low range of the last point to see if it spanned a Fibonacci number. If it did, then I found turn B. Here's the equation using the high at B, 44.5 for 41.68 / 46.89 41.68, or 0.55. Using the low at B we find 43.61 41.68 / 46.89 41.68, or 0.37. The range of 0.37 to 0.55 encompassed 2 Fibonacci numbers, 0.382 and 0.5, so we found turn B. BC/BA retrace. The retrace of BC to BA used the low at A, the high at B, and the last point used the high-low range of C. C has a high-low value of 42.92 to 41.82. Plugging the values into the ratio formula BC/BA, we find the range to be 0.57 to 0.95. The range comfortably fits the numbers listed in Table 19.1, so we found a valid turn C. DC/BC extension. The extension works the same way as a retrace. In this case, the formula is DC/BC. Using the high-low value of D, 50.03 to 48.19 gets a Fibonacci range of 2.34 to 3.02. Point D spans the 2.618 Fibonacci number, so D qualifies. I use the high-low range for the last point in each turn because Fibonacci patterns are complicated, and that makes them rare. Giving them a bit of leeway at each turn helps boost the sample count without including bogus patterns. At least, that's my impression of the results. Your software may use a different algorithm and find different results. D/XA retrace. For the last turn, I use a 3% window, plugging numbers into the ratio using the high at X, low at A, and high at D gives a value of 1.6. That's within 3% of the target 1.618 Fibonacci number. The pattern qualifies as a valid bearish crab. Duration. I limited patterns to no more than 6 months long. The stock dropped from D just as it was supposed to, cutting price more than half in less than 3 months. Don't expect this kind of decline from bearish crabs, though. Focus on failures. Figure 19.3 shows what I consider a failure of the bearish crab to perform as expected. I show the crab marked by turns X, A, B, C, D. The turns have been checked, and they qualify as a valid Fibonacci pattern. Volume trends lower at F, verified using linear regression, probably due to the tall volume spike at the start of the pattern. The move from the July peak in 2016 to D is a nice and gentle rounded turn. The rising channel at G forms a handle for a cup with handle pattern. That's a bullish pattern, and it works in this example. Price rises after the handle, peaking at 52 and change in mid-November not shown. Let's focus on the crab. In this example, price turns lower at D, but price doesn't drop far to E. That drop measures 3%, well short of the 14% average drop for bearish crabs. This crab shows an example of what I call a 5% failure. I count how many times a chart pattern fails to see price drop more than 5%. The 5% failure rate for crabs is almost 20%. That's high, but anything above 0 is high if you're on the losing end of a trade. Price drops to E in this example, in a one-day plunge before beginning the retrace. The stock moves higher as I discussed. If you were to short the stock at D, you would have difficulty pulling out a profit from the trade. If you held a stock long and expected a steep drop at D, and sold proactively to maintain your profit, the pat on the back you gave yourself as price dropped to E would be a hammer blow to the shoulder when the stock peaked at 52 in the winter. So let's discuss the performance numbers to get a better handle on how bearish crabs actually perform. Statistics. Table 19.2 shows general statistics for the bearish crab. Number found. I dug up 1566 crabs in 883 stocks using data from December 1990 to June 2019. Not all stocks covered the entire time, and some stocks no longer trade. Break-even failure rate. This is a count of how many patterns fail to see price drop more than 5% below the high at D. The lower the number, the better. As the table shows, and as one would expect, bear markets have less than half the failure rate of bull markets. That's because price is following the downward market trend in bear markets instead of dropping against a rising trend in bull markets. Average decline after D. I measured the average decline from the peak at D to either the ultimate low, the lowest low before price climbed more than 20%, or the lowest low measured from D to where price closed above point D. Patterns in bear markets show larger declines. No surprise there. Volume trend performance. The volume trend numbers are random. However, the performance numbers confirm that crabs with upward volume trends, as measured using linear regression from the start of the pattern to the end, X to D, marginally outperform those with downward volume trends. I consider the performance differences to deserve a yawn. Trading tactics. Swing traders will want to pay attention, especially if they aren't shy about shorting a stock. The bearish crab is all about going short at or slightly after turn D. How well does that work? I crunched some numbers, and Table 19.3 shows them. How often does price turn at D? If price doesn't turn down often enough, then the pattern is unreliable and difficult to trade profitably. The crab does a good job forming a minor high at D and pushing price lower. The turn rate is 87% in bull markets and even better in bear markets. In other words, you can depend on price turning lower at D. How many drop to? Even if you have a high turn rate for price dropping after D, it doesn't do much good if price doesn't drop far enough to make a profit. 5% failure rate shown in Table 19.2 helps assess that, but so does measuring how often price reaches one of the turning points in the pattern. For example, in the patterns I looked at in bull markets, the stock saw price drop to X, the closest point below D, 59% of the time, and slightly better in bear markets, 68% of the time. That's not very good. Turns A, B, and C are lower than X, and they show price struggling to reach them. The percentages shown in the table aren't that good, so do take care if you decide to short a stock showing a bearish crab. If you own a stock long, it might be prudent to ignore the pattern and just hold on, but that decision rests with you and your situation. It might be that the crab is warning of impending doom, like Figure 19.2 shows, or it might be a Figure 19.3 type of fake out, where price climbs shortly after D. Sample trade. Figure 19.4 shows a stock Sandy traded. Her computer software found the bearish crab marked as XABCD after the peak at D appeared. The volume trend at F tilted upward, but that didn't bother her. She saw the swift rise from C to D and thought it had potential for continuing the uptrend. Why? See that pattern, the two converging lines after D, she pointed to her computer screen. That's a pennant. Those can be half-staff patterns, meaning the upward trend might be only half over. But doesn't the bearish crab warn of a downturn at D? I asked. Let's not confuse the issue with facts. To calculate the height of the flagpole, she used the high at D 47.20 and the low at H 42.40 as the start of the flagpole. Why H, I asked, and not C? H is where price starts to go vertical. The height of the flagpole was 4.80. The bottom of the pennant was at 46.15 for a target of 50.95. The target is below round number resistance, 51, but pushing through 50 will pose a challenge. Let's use 50.93 as the target so I get out before other traders who will sell at 51. She placed a buy stop a penny above the top of D to get into the trade as soon as possible. The buy stop triggered at E, and she received a fill of 47.21. What about a stop? Stop. What's that? She grinned. The bottom of the pennant was at 46.15, so she placed a stop-loss order at 46.07. With a buy price of 47.21 and a stop at 46.07, the potential loss was a reasonable 2.4%. If price reached her target, that meant a gain of about 8%. That's a win-slash-loss ratio of about 3 to 1, but I don't really pay attention to that. 8 days after she bought, the stock looked as if it were heading higher to the highest peak on the chart. Then things went bad. The stock eased lower, dropping far enough to hit her stop at G. She lost 2.4% on the trade. It was a winning trade, she said. My eyebrow shot up. But you lost money. I won because I traded it correctly. I followed my trading plan. If you focus on perfecting your technique and not on money, you'll do better with less stress. End of Chapter 19. Chapter 20. Crab Bullish. Results Snapshot. Appearance. The pattern is composed of 5 turns, 4 of which are based on Fibonacci ratios. The bullish crab is one of the Fibonacci-based patterns. That means the pattern's turns must pass inspection by the Fibonacci police. I'll explain that in identification guidelines. I measure performance of Fibonacci-based patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an upward or downward breakout. Therefore, the layout of this chapter is different from most other chapters in this book. The failure rate for bullish crabs ranks first best, not shown in the above table, compared to other Fibonacci-based patterns, and they are substantially below non-Fibonacci-based patterns, which is good for this pattern too. However, the average rise is nothing to write home about for both Fibonacci and non-Fibonacci-based patterns in bull markets. In bear markets, the average rise beats most non-Fibonacci patterns and places second out of 5 for Fibonacci patterns. Let me emphasize that the average rise doesn't really apply to this pattern, so don't worry about underperformance. We're looking to buy the stock not after an upward breakout, but after the pattern bottoms at D, the end of the pattern. I'll discuss this more later. The reversal rate is the elephant in the room. Careful where you step. If price doesn't turn higher at the end of the pattern turn D, then swing traders will find it difficult to make money. With this pattern, the turn rate is at least 84% bear market on average, which I consider excellent. But we need to see if a sustained price trend develops after the turn. That's because performance might be like many candlestick patterns I tested. Some have high reversal rates, but price doesn't go anywhere. Those candlesticks aren't tradable patterns by themselves. Before we go any further, let's see what a bullish crab looks like. Quick anecdote, when I was living in Boston, I owned 211 Oscars of fish, which I raised from 4. Anyway, I bought a crab and one of the Oscars ate the thing. All I saw of the crab was one red claw poking the Oscar in the eye. I turned vegetarian after that. Tour Figure 20.1 shows an example of a bullish crab with an upward reversal at D. Turns X, A, B, C, D compose the crab pattern. Fibonacci ratios determine 3 of the turns, with the first 2 points being a random selection until you can find a qualified point B. I'll talk more about how I find these patterns in the next section. Let me add that you need a computer with pattern recognition software to find crabs. If you want the one I used, it's available for free at my website, www.thepatternSite.com. Volume F slopes downward in this example, and that's unusual because it happens once every 3 crabs. Even so, we'll see that an upward volume trend in bull markets can improve performance by a few percentage points. At D, price reaches the end of the crab, forming a V-bottom pattern with an extension G in this example, that is, an extended V-bottom chart pattern. The stock makes a dramatic and wallet/purse filling rise to E, where an upward breakout occurs, a close above the high price of turn. A constitutes an upward breakout. Unfortunately, the stock runs out of steam and price collapses, but only for a few weeks before the stair-step rise resumes. Identification guidelines. Table 20.1 shows identification guidelines for crabs. Refer to Figure 20.2 for a visual. I show the bullish crab as turns X, A, B, C, D. Volume slopes upward E, as measured using linear regression from point X to D, the start and end of the crab. This crab breaks out upward at F when price closes above the top of the pattern. However, the rise from D is what's important for swing traders who buy near the D low and surf price higher. Appearance. The crab pattern is a 5-turn beast. What I find odd about this pattern is both the name crab and how far turn D is from the body of the pattern. As they say, it is what it is. Let's discuss how I find the 5 turns. A, B/A, X retrace. I programmed my computer to find minor highs and lows and selected 2 points, X and A. Then I searched for turn B. If the ratio of AB to AX spans one of the 3 Fibonacci numbers listed in the table, then point B is a valid crab turn. To do this, I used the low at X 40.75, high at A 51.78, and for the target turn, the last point of the 3, the high-low range of B, 45.64 to 44.34. Plugging the numbers into the ratio we get using the high at B, 51.78 45.64 / 51.78 40.75, or 0.56. Using the low at B we get 51.78 44.34 / 51.78 40.75, or 0.67. Range 0.56 to 0.67 spans the 0.618 number, so we found turn B. C B/AB retrace. In a similar manner, I use the high-low range of C, 41.82 to 48.23, along with the high at A and low at B. If you plug the numbers into the CB/AB ratio, you get a range of 0.20 to 0.52. That range spans 0.382 and 0.5 from Table 20.1, so we found point C, CD/CB extension. For the extension, I use the same high-low method with the last point D, 34.85 to 33.72. I also used the low at B and high at C. That gives a range of 3.44 to 3.74. The 3.618 number fits snugly in that range, so point D is valid too. AD/AX retrace. For the last ratio, I use a 3% window to check if the AD to AX ratio is 1.618. Plugging in the high at A, low at X, and low at D, we get 51.78 33.72 / 51.78 40.75, or 1.64, which is within 3% of 1.618. In other words, the pattern qualifies as a valid bullish crab. Your pattern recognition software may use a different algorithm and find different results. Volume. Volume shown during formation of the crab is usually upward, and that's good news. In bull markets, performance improves. Duration. I limited pattern length to 6 months or less. That's an arbitrary limit I place on some patterns when searching for them. Focus on failures. Figure 20.3 shows what I consider to be a failure of a bullish crab to perform as expected. Volume F slopes upward as it does over 60% of the time. In this example, the stock reaches point D and price forms a bottom, just as it is supposed to do. However, the stock forgets to rise much, just 2%. The stock breaks out downward when it closes below turn D and makes its way down to E. Price doesn't stay down long at E, just one trading day. Price does a quick reverse and climbs up, forming a near vertical wall to the late August peak. The failure of the stock to climb at more than 5% after D I classify as a failure. Fortunately, these types of situations are rare, happening about 7% or less of the time. The failure rate is low, even for non-Fibonacci-based chart patterns, and it's even lower in bear markets, 2.6%. A stop-loss order placed below the low at D will protect you from this kind of failure. Just be sure turn D is in place. Let's discuss performance using numbers. Statistics. Table 20.2 shows general statistics for crabs. Number found. Bullish crabs are rare. I found them in 530 stocks, identifying just 737 patterns that I cataloged. I found the first crab in July 1991 and the most recent one in June 2019. Not all stocks covered the entire period, and some no longer trade. Break-even failure rate. As I mentioned, the failure rate for bullish crabs is low, lower than traditional chart patterns, and even lower than the average Fibonacci-based pattern. Performance measures the rise from the low at D to the ultimate high. The ultimate high is the highest peak before price drops more than 20%, or the highest high before price closes below D, the bottom of the pattern. I counted how often price failed to rise more than 5%, average rise after D. The average rise from the low at point D to the ultimate high in bull markets needs work. It's below average. The bear market number, however, is above average for both Fibonacci-based and non-Fib patterns. Volume trend, performance. I used linear regression on volume from point X to D to determine the trend. Keeping in mind that in bull markets the average rise is 39%, crabs with volume trending upward see price rise an average of 41%. Downward volume trends are hurt more when price rises just 36%. Bear markets don't seem to care about the volume trend. Perhaps with additional samples they'll take an interest. Trading tactics. As I mentioned, swing traders will want to participate in knowing when turn D is in place, and the math for the pattern can give you a clue. You can predict the price of turn D. Then, wait for the stock to bottom at D. Once the turn is in place, buy the stock and ride it higher. Here are some numbers for you to gauge performance. Table 20.3 shows how price behaves at and after the end of the pattern. Fibonacci patterns have two important features. Price reverses at D and forms a trend. How well do those features work for bullish crabs? How often does price turn at D? Price turns upward most often in bull markets, as one would expect. The bear market is a slacker when price bottoms at D 84% of the time. That's still a good turn rate. How many rise to? After price bottoms in well-behaved crabs, price rises, but how far? Here's where the results are weak in my view. The closest turn to bottom D is X. If you look back at the charts in this chapter, point X is not exactly close to D. So there's a substantial rise just to reach X. Remember that if price closes below D, then I take the highest peak between that point and D as the ultimate high. Price reaches the low at X between 55% of the time bear market and 65% of the time bull market. The table shows the hit rate for the other turns, A, B, and C. For example, if you hope price will climb to the high at A, which is the top of the pattern, price will reach or exceed that target just 33% of the time in bull markets and less than half that in bear markets, 14%. As a swing trader, keep these percentages in mind and trade accordingly. If price is on a tier, let it continue rising until it stops, then get out. Sample trade. Figure 20.4 shows a sample trade that Sam made. His trading software identified the XABCD bullish crab automatically for him, soon after turn D appeared. Volume has an upward slope, E, according to linear regression, but it's hard to see that trend by looking at the chart. Regardless, volume considerations didn't make a meaningful contribution to the trade. Sam knows from experience that when a reversal pattern appears soon after a horizontal peak, it's a disaster waiting to happen. In this case, the horizontal peak was the AC move extended to the right, to the start of the trend line. This elongated top meant the bulls and bears were struggling for control, but couldn't resolve their conflict. The slight downward tilt pushed the odds of winning to the bears. The bears eventually won and shoved the stock downward through support. Even though the bulls tried to rally a few times on the way to point D, they didn't have lasting success, certainly not a trend change. If you were to see the longer-term chart, you'd find that the AC high is really part of a longer-term downtrend that started back in January 2018, suggesting more pressure to send the stock lower. To Sam, though, the stock just looked as if it would continue lower. A check of other stocks in the same industry showed a mix. One was moving up at a good clip over the past year. One was moving up, but at a slower pace. One was flat and four were dropping. It was a mix, but leaning toward being bearish. He did his financial diligence on the company, and what he found supported his bearish stance. Sam placed an order to short the stock a penny below the low at D and received a fill at 17.62. Why short then? His answer: you don't short a stock making new highs, you short ones making new lows. But what about the bullish crab, I asked. It died when the pattern broke out downward. After the order filled, he placed an order to cover his short should the stock rise to 18.56, which was just above the high directly above F. The stock cooperated and didn't just drop, it plunged. At G, the stock reached bottom, but Sam didn't know it at the time, meaning price might have continued down. High volume a few days earlier suggested a bottom, but that's an unreliable indicator. The stock at G made a tall candle with a close near the day's high, which also suggested the stock had put in a bottom. The stock was making lower lows nearly every day on the way to G, and then it stopped. Price recovered. Why didn't he cover the short then near G? Greed, he said. Pure and simple. It looked like the stock had put in a bottom, but I've been fooled before, so I held on. He shrugged. Price rebounded and made a V-shaped turn. When the stock closed above overhead trendline resistance, the day before H, he covered his short the next day, H, and received a fill of 16.68 for a profit of almost $1 a share. Had he sold at the low at G, he would have made almost $4 a share, but that would have been a perfect trade, and those are as rare as fish eating crabs. End of chapter 20.